Hello, guys. Hope all of you are doing well. And welcome all to this revision session on derivative analysis and valuation for CA Final SFM. It's a pleasure having all of you here on this Sunday evening. So, friends, let's start off right away. Let's not spend more time on anything else. Let's just start off. Before we start off, I wish to make a few points which I want all of you guys to remember as we go through this entire session. First thing is, this is a revision session, so obviously I cannot or I will not be able to do 100% of everything. I will try my best, but most likely there will always be 3 to 5% that will be left out, which you'll have to handle on your own. Okay, that is the first part. Second part is there are 2 or 3 small things that I will definitely not be covering. Okay, one of them is these small theory aspects on things like what is the difference between index futures and stock futures and some other things like that. Very, very small topics which are pure theory topics which don't have any practical application as far as ICA examination system is concerned. So I will not be doing those. Same way, I will also not be covering swaps because those are covered under a different chapter altogether. So swaps will not be covered. And same way, commodity derivatives, we have 1 or 2 problems, but commodity futures related stuff, the formula is basically the same. So we will cover it up in the futures part. Okay, that is the second part. Then third thing, what I want to highlight to you guys is the PDF. What I'm going to actually what is visible on the screen now will be shared with, or rather will be uploaded as part of the, it'll be you can actually download it by, going to the description. It is not yet uploaded. It will be uploaded after the session. So once the session is over, we will upload the PDF along with my workings in a Google Drive or OneDrive and share the link as part of the description. So please go there and download the download the file so that it will be easy for you guys to go through stuff as I'm teaching stuff or as I'm explaining things to you. That is the other part. Then finally, if some of you are not 100% fully thorough with this kind of revision and want more practice problems and all of that, you can join our enroll in our individual module course, which is opening tomorrow. And you can enroll in that course and take the full course of the entire chapter of derivative analysis and valuation. Right. And lastly, this is a question that one student sent me. Before I start off, I want to just clarify that my name is written as Sriram Somyajula CFA, and I'm why is CA not written? So friends, I did pass my CA exams long ago. So I'm a CA final pass out 2003. I in fact even got a campus placement, but then I am no longer a member, which is why I have not used the prefix or suffix CA or ACA, for my name. So I want to just clear that out of the way. I have passed my CA exams quite some time ago, right? And also, of course, I have other qualifications. You can probably check it out on my LinkedIn profile. Anyway, now with this introductory part out of the way, let us start off with the topic for today: derivatives analysis and valuation. First up, right, is basic definitions. So I will just go through to the extent of helping you guys understand what these words mean and how they're relevant to what we're actually going to learn further in the subsequent slides or in subsequent part of this discussion today. Right. So one more point, guys, what I want to highlight, if you have any questions or queries or something like that, please post them on the YouTube channel or in the Zoom chat. Either ways, I'll be taking questions after every 10-15 minutes. And, if we have all related questions at one time, it will be better, instead of having multiple questions at different points of time. I am seeing somebody is drawing something on Zoom using the Zoom, markup tool. Please don't do that. So please feel free to ask questions to the extent possible, whatever I can explain in this, next 1.5 to 2 hour session, I will definitely try. But beyond that, probably you can always post your queries in our forums on our app or website. Okay, let's get started. So what is a derivative? So, I just want to get this thing out of the way. A derivative right? A derivative is a contract. A derivative is a contract. But what kind of contract? It is a contract which is based on another asset, which is called as the underlying, and it derives its value from this. Okay, this contract derives its value from the value of another asset, which can be called as an underlying asset or underlying. People use different nomenclature. This is the first thing that I want you guys to remember. Why I want you guys to remember this thing is you have to understand this concept very, very clearly. When we say derivative, we are referring to a contract only. We are not referring to a stock. We are not referring to a bond, or we are not referring to gold. We are not referring to commodity. We are referring to a contract which is built on those assets like stocks or bonds or commodities or gold or metals or whatever it is. Right? We are referring to a contract which is based on them. Right? And it is typically for a future date. Future date. It is for a future date. Right, wherein you will agree to buy something, or you may agree to sell something, or you may agree to do something with respect to this asset at a future date. You are entering into a contract today. Okay, so that is the first part. Now, if you look at the types of derivatives that we have, we primarily are going to discuss forward contracts, future contracts, and options. Swaps are covered in a separate chapter. And commodity derivatives are not discussed so much in our, with respect to problems and all in our exams or even in the study material, but we will cover briefly the formula that is linked to it, right? But we will primarily be discussing about these three: forwards, futures, and options, right? So let's move with that. Futures and forwards, or forwards and futures, whatever you want to call them. See, let me first explain what a forward contract is, then automatically we'll understand what a future is. A forward contract is an agreement to buy or sell at a future price, at a future date, at a predetermined price. Sell asset. Okay, let me call this as an asset. This asset can be brinjal, it can be tomato, it can be gold, it can be equity stock, it can be equity index, it can be anything, right? At a future date, at a predetermined price. Now, a forward contract is basically, think of it as you are entering into an agreement with a vegetable seller, right? Roadside vegetable seller or a vegetable shop. You say, next year, I will buy brinjal at 100 rupees. Let us say today, brinjal 1 kilogram is 90 rupees. You are going and entering into a contract with that brinjal seller saying that next year, that is exactly after 365 days, I will buy brinjal at 100 rupees a kilogram, right? So that kind of an agreement is called as a forward contract, right? A future contract is different from forward. It is very, very similar to forward, but there are some dissimilarities. Now, let us understand the difference between forwards and futures. See, I will write here forward and future. Okay, so forward contracts can be for any kind of quantities or lots or any kind of sizes that you want, as long as the seller and the buyer of the contract, or as long as both the parties in the agreement to the forward contract agree that I will sell 1 kilo, 1.1 kilo, 1.2 kilo, 1.3 kilo, anything, any number that both the parties agree, they can enter into a contract, right? That is completely customized. Whereas a future is a standardized contract. It is same like a forward contract, but it is standardized. That is, you cannot enter into random numbers. You have to enter into contracts for, let us say, exactly 1 kilo or exactly 5 kilos or exactly 10 kilos. There are certain specified lots that are mentioned or that are decided by somebody. Who is this somebody? This somebody is an exchange. These future contracts are traded in an exchange, whereas forward contracts are between two parties, right? Without any exchange. Here, there is always an exchange. Whereas in a forward contract, there is no exchange. In a future contract, there is always an exchange, right? So when there is an exchange and there are a lot of buyers and sellers in an exchange, you cannot have these, 1.1 kilo, 1.2 kilo. I will buy, 11 grams of gold. I will buy 11.5 grams of gold. You cannot have contracts like that. So those contracts are always standardized, right? Then these are specific maturity and tenure. So forward contracts are not for specific maturity or tenure. That is, they can be for anything. You can customize it for 11th of January, 12th of February, 14th of March, anything. Whereas your future contracts have to be definitely for a specific period that is determined by the exchange. That is, they can be 1 month, 2 month, 3 month, 4 month, but they are typically at the month end. So if you look at India's equity futures, they are settled on the last Thursday of the month. Right. So there are specific dates and timelines that are agreed where there are, where the exchange standardizes all the contracts. Then margin money. In case of future, it is in case of forward, in case of forward, it is between two parties. The both parties may agree for a margin, need not agree for a margin. But in a future, because there is a exchange involved, right? The exchange, that is the stock, a commodity exchange or a stock exchange or a currency exchange, whatever exchange that is involved, that exchange has to take care of the risk that one of the parties will not honor the contract. Now, I will actually get into that. What is that contract, what they will not honor, then you will understand. See, initially we said we'll buy brinjal, right? This brinjal at 100 rupees after 1 year when current market price. So this after 1 year, this is called future price. Future price is 100 rupees. Spot is 90. Right, and after 1 year. Now there are two parties, A and B. A is the buyer, C is the seller. Right. Now, if let us say after 10 days, right, the spot price from 90 moves to, let's say, 50. Right. Now the buyer of the contract, that is, when you say buyer, it means the person who agrees to buy. Right. A agreed to buy certain item, a brinjal, after 1 year at 100 rupees. Now, suddenly, after 1 day itself, the market price fell from 90 to 50. He entered into a contract thinking after 1 year, the prices may go up, but within 1 day, the price has fallen down to 50. So what will happen in case of a forward contract? There is a risk that A may not honor, A may run away. A may run away. So when A runs away, then what happens to B? B is left holding a paper that is absolutely worthless. Right. So B has to trust A and A has to trust B, because ulta also can happen. That is, after next day, let's say the price, why next day? Let us take 364th day. On 364th day, let us say the price becomes 200 rupees. Now A wants to buy from B at 100. They both agreed 1 year ago. But now the market price is 200. Okay, now B will say, no, boss, this is just a contract. Let me run away. I will not honor the contract. Why will he say that? Because he has to agree. He has agreed to sell to 800, whereas today's market price is 200. Correct. So if B sells in the market, he'll get 200 rupees. Whereas because he's having to sell to A, because he already agreed at beginning of the year, he has to sell it at 100. So he will lose, right? Because he could have made 100 rupees extra profit. So B may run away. Like this, there is a risk of either parties defaulting on the contract. Which is why when you have an exchange, right? When you have an exchange, which is why there is this whole credit risk concept, what is there in the last line, right? In a forward contract, there is credit risk. In a future contract, there is no credit risk. Because this credit risk is there in a forward contract, this credit risk is there because there is no margin. Typically, there is no margin in a forward contract. Whereas in a future contract, no credit risk is usually there, or even if it's a very, very small percentage, because there is an exchange and the exchange says, give me margin. What is this whole margin business? See, if you look at, this earlier scenario, 50 or 100 or 200 or whatever, exchange will say, as the price keeps coming down, the price keeps going up, the probability of default of one of these guys keeps changing. Let's say the price goes down, then there is a high probability A will default. If price goes up, there is high probability B will default. So what exchange will do? Exchange will say, okay, whenever the price is going down, whatever is the difference between the agreed price and the current market price. Current market price is 50, agreed price is 100. Typically, they will say, you have to keep depositing the difference between these two into the exchange, and the exchange will keep giving the money to this person called B, or they will maintain it somewhere. We will understand it in depth later, but they will do that. Right. Same way, they will say, if the price keeps going up, they will say, B, you keep giving me the money to the extent of difference between the current market price and the agreed price of the contract. So the difference between these two, you keep depositing money. So there is somebody in between who is acting like a trustee. He's saying, I will ensure that, there are no defaults. So both of you keep giving me margin. So whenever there is a risk of default or anything, I will take the money and, give it off to whomever it is supposed to be given. So because there is no margin in forward contracts, typically there's no margin. So there is a credit risk. Whereas in futures, there is margin money involved and hence there is no credit risk. Then product specifications. Here also I said forward contract is completely customized. So there are no standardized specifications. Whereas in a future, fully thorough specifications. Delivery. So forward contracts usually, okay, are delivery based, right? And future contracts are usually cash settled. What is cash settled? What is delivery based? Delivery based means the example of brinjal, what we took, right? If you enter into a forward contract for brinjal, you will have to take the brinjal and give them that 100 rupees. Whereas if you enter into a future contract on brinjal, there are no future contract, but I'm just taking the example. Please go with me on this. If there are, if you enter into a future contract on brinjal, on the final day, the day of settlement, that is after 1 year, right? Instead of giving 100 rupees cash and taking brinjal, whatever is that day's market price and the agreed price, the difference of that actual money, whatever is the difference between those two, right? We saw this 200 rupees. If there is the market price is 200 and the agreed price is 100 rupees will be given by the seller to the buyer. Or if the market price is 50 and agreed price is 100, the buyer will give 50 rupees to the seller. So it is cash settlement. Futures are cash settled, whereas your forwards are usually delivery, and even futures also sometimes there are delivery based futures. Relationship between the parties. See, in case of forward contracts, usually they are known people. So you will go to a vegetable seller who's near your house. You will go to a jeweler who you know. You will not go, or you will go to a banker for forward contract some currency who you know. You will not go to some unknown person and enter into a contract. Unknown person will not enter into a contract with you. Whereas futures, you are entering it into with a institutional mechanism of an exchange, right? So you will never know the other party, the exchange and the clearing house. They will have millions of buyers, millions of sellers. Just like when we buy stocks, right? We don't know who the eventual seller is. You are just buying stocks. You just place an order in the stock exchange. You'll get the stock will be delivered. If your price is hit, your stock will come to you or go away from you, right? Same way, in case of future contracts, relationship between the parties is unknown. Then customization, I said forwards are fully customized, futures cannot be customized. So these are primarily the differences between future contract and forward contract. Now coming to the next part, excuse me. There are three kinds of players who are typically there in these derivatives market. This can be forwards, futures, options, swaps, whatever. You take any kind of derivative, there are three kinds of players: hedgers, arbitragers, speculators. Now, who are these hedgers? Hedgers are people who already have exposure. The word is exposure. That is, if you take, let us say, a company, Infosys. Infosys gets most of his money from what? Abroad. By how? Because they deliver a lot of services to people outside India. So they deliver services to GE or Citibank or people like that. So they get currency as they get US dollar currency revenues. That is, when they bill, they get money in the form of currency. So when they get money in the form of currency rates can fluctuate. So what they will do, they will, in order to ensure that the fluctuation of currency rates is not negative, does not have a negative impact on Infosys P&L and balance sheet, Infosys will enter into hedging transactions for hedging that particular exposure. Exposure means the total volume of foreign currency export receivables that Infosys has. That is called as exposure, right? So they have an exposure and they hedge the exposure. Hedge means they mitigate the risk of the exposure. That is what, those are the first kind of players. They are hedgers. So I took example of exports. You can also have imports. Let us say there are petroleum companies, BPCL, IOCL, Reliance, fertilizer companies. All these people have imports. So when they import, they have to pay in foreign currency, in US dollars. So when they pay in dollars, there could be changes in rates of US dollar INR exchange rates. So in order to reduce the risk of changes in rates, which may have a negative impact on the P&L and balance sheet of these companies, they may enter into transactions hedging the currency risk. Right. Second, people are arbitragers. Arbitragers are those people who basically earn money without taking up any risk. No risk, basically no risk. What they do is, I'm giving you a very simplified example. Okay, let us say there is a stock which is trading in both NSE and BSE. On NSE, the stock price is 50 rupees. On BSE, the stock price is 51 rupees. Okay, I know that there are depositories, intermediaries in between and all of that. For a moment, just think of it very, very simply. In NSE, it is trading at 50 rupees. In BSE, it is trading at 51 rupees. So you can buy on NSE at 50 and sell on BSE at 51, no? Right? There is no risk. You enter into an order simultaneously, both the places, because it is possible electronically. You place a buy order here, you place a sell order here, you'll make 1 rupee profit. So arbitragers are people who enter into transactions in more than one market using at least two transactions, wherein they completely are not exposed to any kind of risk, but are making money out of it. So arbitragers basically make money without taking any risk. Then finally, you have speculators. Who are speculators? Speculators are exactly opposite. They take risk. They say, no. Infosys stock is today 5,000. I think it will go to 6,000. Let me go and buy the Infosys stock. Right. So they will take bets. They will take bets saying that there is a reward to be made, and hence I'm willing to take the risk. Arbitragers, they will not take any risk. They will always cover their positions. They will do one thing on one side, another thing on other side, and both the positions will be covered, and they will make risk-free returns. Right. So these are the participants in the derivatives market. Now, one more thing I want to highlight is when we talk of derivative markets, it is basically all these futures, forwards, options, all the swaps and all of that, right? There is one more market called cash market. What is this cash market? Cash market means you are paying money and taking something immediately. So if you go to a vegetable seller and buy brinjals for your house, you are basically buying them for now, right? You want to cook them today evening or today night, or whatever it is. Or you buying jewelry, you're buying it for immediately you're taking possession. So that kind of a market where you buy items for immediate delivery and where you pay cash immediately, those kind of markets are called cash market. So in case of stock markets, where you pay money and take the stock today itself, that is where you buy a stock, right? That kind of a market is called cash market. As a derivative market is one where the delivery is at a future date. Right. Now, in cash market and derivative market, in cash market, typically, what are the differences? Lot size are slightly, free or flexible. Let me call it flexible. In cash market, flexible. Right. You can buy one stock, two stock, three stocks, four stocks. You can't buy 0.5 stocks, but you can buy one stock, one share of Infosys, two shares of Infosys, three shares of Infosys, like that. But in derivative market, you cannot buy flexible lot sizes. You have to buy minimum 10 or minimum 20 contracts, minimum 50 contracts. So it is not flexible, right? Motive. Cash market is typically either for investment or hedging. Okay, that is, you are buying a stock either to invest in it, or you're probably entering into a transaction where you're trying to hedge something, or it is for consumption. Okay, whereas your derivative markets are for three motives. What I said, they are for speculation, arbitrage, and hedging. Consumption is not there. Okay, then margins. Cash markets usually typically no margins, whereas derivative markets have margins. Transfer of ownership, immediate. As I just said, right? Immediate, future date. In case of derivative market, it is future date. So this is cash. This is derivative. Okay. Then cash commitment, immediate in case of cash market. This is at a future date. In derivative market, you have to pay cash at a future date. Types of assets. Typically, these are consumption assets or investment assets, or sometimes tangible assets. Here, typically, you'll have intangible and also tangible. I'm not saying tangible will not be there. You'll have, gold, metals, commodities, all of them will be there, but you will also have intangibles like stocks, currency, right? I know you can see currency notes of currency coins and notes, but then, when you're doing currency derivatives, which are interest rates, okay, interest rates, tell me how will you see interest rates? You can't see interest rates, right? So these are, you typically have large volumes of intangible assets, whereas here you will typically have this consumption oriented, investment oriented, or tangible assets. Next, futures price. So when I say futures, yes, right here, futures and forward, both of them are same. There are contractual differences between future and forward, the way the contracts are structured, but there are there are almost no differences in terms of pricing. In terms of pricing, there are almost no differences, whereas there are contractual differences. So whenever we discuss about futures and forwards, we'll take that the pricing is the same. It is, prices are determined in the same manner. Now, in this, what you have to understand is the price of a future contract is spot plus cost of carry minus dividend. So here, please note, it is minus, right? So if you are, goes straight from the concept of time value of money. Let us say something is worth 100 rupees today. After 1 year, it will be worth, and let's say interest rates are 10%. After 1 year, it will be worth 110 rupees. It is absolutely simple. It is as simple as that. However, If this 110 rupees is giving you something in return, which is like a dividend, let's say 2 rupees, then you subtract the dividend and you value this at 108 rupees, right? Because 2 you're already getting in between, no? In 2 rupees, you're getting in between. So the 2 rupees is deducted as dividend, and the value of this particular contract is 108 after deducting dividend. Right now, this part, this interest portion, right? This is called as cost of carry. This interest portion is called as cost of carry. And interest we compute in typically, these 4 methods, or rather 4 ways or 4 formula you can say. One is simple interest. All of us know principal into time into rate by 100. That is a very, very simplistic way of computation of interest. Second is compound interest, where you have, annual compounding, where you do P is into 1 plus R by 100, whatever is the rate. Let's say rate is 10%, you'll do 1.1 whole power T. T is 1. Let's say you take 1 year. So you'll do 1.1 power 1 into principal. That will give you your final amount, including principal. Right? If it is periodic, then there is this formula. If some of you have already finished the chapter on bonds and security valuation, then you'll know this. If let's say the interest rate is 10% per annum or 12% per annum, right, and interest is compounded half yearly, then it is computed as, the future value is computed as 1 plus 10% by 2 whole power 2, right? Whole power T2 into 1, whatever is the number of periods and the time, you do that. So you're basically doing 1.05 whole square. This is not equal to 1.1. Okay, 1.05 whole square is slightly greater than 1.1. Why? Because you're compounding for 2 periods at 5%. And how did I get 5? I got it because I said it is 2 period compounding, 10% by 2. So, and most important is this continuous compounding. This is what is typically used in stock markets. Continuous compounding, we will not get into the mechanics and logics or the derivation of what is this continuous compounding. For us as students of CA, it suffices to understand that it is P into E power RT is the future value. Here, future value is P into 1 plus R by 100 power N, P into 1 plus R by N power NT. Same way, it is P into E power RT. E is E is equal to 2.71 something, 7182 or something like that, right? So you do continuous compounding. That is every instant, every minute second, millisecond, microsecond, you keep on compounding it. Then if you were to assume such kind of a compounding, then the future value is arrived by this P into E power RT. Right now, future value of a stock is spot value. Spot value is today's market price is into E power R minus Y. What is this Y? Y is equal to dividend. Okay, dividend. I said we are adding the cost of carry and subtracting dividend. So here that is taken into account here. That is Y is dividend, and it is not simple dividend. It is dividend yield, and this dividend is also a dividend yield on a continuous compounding basis. Dividend yield on a continuous compounding basis. Right. So the formula is future value F is equal to S0 into E power R minus Y into T, right? So T is time in years, R is continuous rate, Y is dividend yield rate. Okay, and S0 is spot. And E, I said 2.71. Now, what am I supposed to do if this 2.71 value numerator is given, not given? How to find out? There are problems. When we solve those, you will understand that. Right. So now let us come to other aspects related to this. Or I think I have to just explain this also. Future value of a commodity is for a commodity, you also have something called S and C. These are E power R plus S minus C into T. S is storage cost. C is convenience yield. Okay, I've explained this in depth in our classroom, but for us to understand, this is not there in the study material as of now. Probably at a later point of time they will include it. But this is the formula for pricing a commodity. If at all you get this, please take note that you have to compute the commodity future value using this particular formula. Now moving on. What are the other concepts related to futures? Backwardation contango. So if you look at today's price, right? So let us say this is price and this is time. So today, let us say the price is 100 rupees. Based on time value of money, after 1 year, the price, let us say, is 110 rupees, right? So price is like this. After 2 years, let's say the price goes up further. So future prices are always trending upwards. This process is called as contango. That is, markets are said to be in contango when future prices are higher than spot prices. Backwardation is exactly ulta. It says the future prices are lesser than current spot. That is, there are days, there are times when this can happen, when, you know, this is price, this is time, today's price and future price, present and future, right? So prices are expected to fall. This may happen probably because they're expecting the market to crash, they're expecting that asset class to crash, or there could be multiple other reasons, right? But markets also too tend to be in backwardation sometimes. Then there is something called as margin, initial margin and maintenance margin. Now I explained to you this entire concept of credit risk, where I said that because there is credit risk, there are trust issues, both parties or parties to the contract actually have to maintain margin in case of future contracts. In forward contracts, typically there is no margin. So let us understand what this entire margin business is, especially what is this initial margin and maintenance margin. Now, initial margin. Typically, exchange says, you know, some 8% or 10%, some percentage. Okay, let us take 8% only. They'll say, put 8% of contract value as margin and 6% is maintenance margin. What is this maintenance margin? Whenever the margin, total margin, right, total margin amount with exchange or deposited goes below 6%, you have to bring it back to 8%. So we will understand this when we solve a problem. For now, please understand this concept called initial margin, maintenance margin. Initial margin is whenever you enter into a contract, you put this 8%. This 8%, so whatever gains or losses that you keep making will keep getting adjusted from this. Moment it touches the lower level of 6, you are supposed to bring it back to 8. Suppose the margin that you have in your account is 15%, then you're not supposed to do anything. But moment it comes down to 6, you are supposed to bring it back to 8. If it goes up and if instead of 8, it goes to 15, then you can take the money and you can basically take the 7% back into your bank account. That is also possible. But if it comes down to 6, you are supposed to bring it back to 8. So the minimum level is 6, and whenever it falls to 6, you have to bring it back to 8. At the start of the contract, this margin is 8. Now, before we solve the problems on margin, I want to explain what are the kinds of strategies that people will execute when they are doing, when they're entering into future contracts. See, the first kind of thing is when investor expects an increase in price of a stock, the strategy is to go long. Go long means go buy. Going long means basically buying. So they go long on futures, right? If they expect a decrease, you short, that is you sell the futures. So if you're thinking that some price will fall after a few days, you will say, oh, after a few days, today itself, I will agree to sell something after a few days at a price determined today. So basically you have an idea that brinjal prices are going to fall after 1 year. So you'll say today itself, I'll agree, whatever is the best price possible today, I will try and enter into a contract to sell the brinjals after 1 year. Right? If other people don't know that brinjal prices will fall, then you'll make a killing, right? You'll agree to sell to all of them at 100 rupees, whereas after 1 year, the price may be 50, right? So basically, if you believe that the prices will fall, you enter into sell contracts. If you believe that the prices will rise, you enter into long or buy contracts. Then if one more case, investor has a bullish outlook for Indian market for the month of June. So the investor will go long on June index futures. What are index futures? So if you can have future contracts on stocks, you can have futures on indices like Nifty, Sensex, Bank Index. There are multiple indices. You can go along on index futures. Then so these stocks and indices are two types of individual stocks and indices are two types of futures which you can trade on stock exchange. Now, investor has a bearish outlook, you short the index futures. Same way, if the investor has bought shares of RAL and he wants to hedge his position, then if you have already purchased, right, what is the probability that, or what is the kind of loss that you will face? See, I have already purchased something. What is the loss that I will face? I will face a loss that the price will go down. Correct? That is the loss I will face. If I face that loss, how will I hedge? Hedge means mitigate. How will I mitigate that risk? I will mitigate that risk by entering into counter or opposite kind of a contract, which is I will say, I already have the asset. Now I will agree to sell it at a future date at a price that is determined today. So you will basically short. You will short September futures. So when the price falls, On the real stock, you make a loss. But on the futures contract, what happens is you agree to sell to somebody at a future date, let us say 100 rupees, but the price is now fallen to 50. So on that date, right, whenever is the final date, you are going to make 50 rupees gain. Why? Because you have agreed to sell to him at 100, whereas the market price is 50. So that person, when they do cash settlement, they'll give you 50 rupees. That 50 rupees will offset the loss that you had. What is the loss that you had? You already had the RAL shares that you instead, when you had to sell them off at 50. But so you incurred a loss of 50 rupees. How 50? Original 100 minus you are now selling at the revised market price of 50. So you incurred a loss of 50. That loss on the stock is compensated by the gain on short futures. We will see a problem. You'll understand this much better. So don't worry. Then investor wants to hedge his portfolio, then short index futures, and future value to be shorted is equal to portfolio value into portfolio beta. That is, you will basically take the total value of the portfolio multiplied with the portfolio beta. To that extent, you will short the index futures. You will have a problem on this. You will understand this better. So please do not worry. Then what is the situation? Actual price is less than theoretical price. This is an interesting thing. So futures price are supposed to be based on this, whatever formula we said, right? Future is equal to spot into e power RT. Okay, R minus Y into T. This is what we said. If you do this, let us say the price is coming to 100 rupees. But in the market, the actual price is trading at 90. Futures are available at 90. So something that is available cheap, right? You buy. Something that is costly, you sell. So you sell for this 100 and you buy for this 90. So what do? On day 0, you go and buy these futures which are trading at 90. So this is the first part of the contract. Then you short sell the stock. So for this, let us say the stock is at some 95 or 96 or something. You short sell the stock. Shorting is basically selling a stock which you don't have, right? That is called short selling. So this 95 rupees, you sell something for 95 and you'll get the money, right? Whatever 95 rupees you get, you go and invest in market, right? You go in a risk-free asset. You go and invest this 95 rupees in a risk-free asset. So you short sold, you got plus 95. You invested, you minus 95, right? So you basically, our net cash flow is 0 on day 0, because futures they're just a contract. You're just entering into a contract. There's no cash flow attached to it, right? So there's no cash flow here. Here you've got 95, you've sold off 95, or you've invested 95, your cash flow is 0. On the maturity date, what will happen is on this 95, whatever you have invested, you will get interest. Let us say some 2 rupees. So you'll get back 97 rupees. Okay. Then what you do is you've already entered into a futures contract to buy something at 90, correct? So out of this 97, you give 90 to that person and buy the stock. You buy the stock, right? You give this 90 and buy the stock. Then you still have 7 rupees left. Wait. Then what do? Give cash, take delivery of the stock, and you buy. So you give basically cash and buy the stock. You give basically the cash to this person and take the stock, and that particular stock, whatever you have short sold, because you have short sold to this particular person, right? So that person, you'll give it back, that stock, to this particular person, and you will close the contract and you will make this 7 rupees gain. So we will do a problem on this also. You will understand this better. Right. Then exactly opposite situation where actual price is more than theoretical price. That is, current market price is, let us 100, and theoretical, this is current market price, theoretical price is 90. So if the theoretical price is 90 and current market price is 100, you exactly do the ulta thing. I will explain this to you when we solve a problem. It is much, much easier and better to understand it that way. Now, types of problems that are typically asked in futures are 3 types of problems. Some are margin related, then there is something related to hedging, and then there is something related to arbitrage. We have discussed on all 3 very, very briefly. Now we will solve the problems. You'll understand them superbly. Okay, you just pay attention to these 3 aspects that, these are 3 kinds of varieties of problems. You'll be able to solve these problems in the exam if you get them, if you understand these concepts. Can you just hold on for a sec? I am getting some questions. I just want to see. Okay, great. I've got the responses. Thanks. I'm moving forward. So we'll understand this whole margin business by taking this example. Okay, so the price of March Nifty futures contracts on a particular day was 9170. On a particular day, it was 9170. This is the future contract price. The minimum trading lot of futures is 50. So I told you that you can trade only in lots. So you have to minimum do 50 contracts. Right, the initial margin is 8%, maintenance margin is 6%. So you have to maintain, you have to initially put 8 and minimum you have to maintain 6. The index closed at the following levels on next 5 days. It closed at 9380, 9520, 9100, 8960, 9140. You are required to calculate mark-to-market cash flows and daily closing balances on account of an investor who has taken a long position of 9170, and you are supposed to calculate net profit or loss on the contract. Very, very interesting problem. Let us go ahead with this. So I have put up this broad table here. On day 0, when you are entering into the contract, the price is 9170 and the lot size is 50. So you multiply 9170 into 50, you will get 9170 into 50, right? You will get 4,58,500, right? You will get 4,58,500. So that is just a contract. On that day, you are supposed to deposit 8% margin. Right. So 8% into this comes to basically 36,680. So you deposit this particular money and the exchange maintains an account called margin account in your name. And in that money, in that account, you have to maintain 36,680. Whereas the 6% margin requirement on day 0, you have to enter that 8%. But the minimum it can go down to is 6% of what? Is 6%. 6% of what? 6% of this into this. So 9170, if you do 9170 into 50 into 0.06, you'll basically get 27,510. So at all times, it should be 6% of the contract value. Contract value is whatever is the current price into the lot size. So at all times, it can never go below this, but initially you are supposed to put this 36,680. Now on day 1, what happened? The price went up from 9,170 to 9,380. So it has gone up by 210. Now 210 into 50, basically your 10,500 is the gain that you have made. So this entire 10,500 gets added to your account, and this 36,000 plus 10,000 becomes 47,000. 36,680 plus 10,500 is 47,110. So your margin now is actually increased, right? So this 47,180 is in your account as, in your name with the exchange as margin. You can, if you want, you can withdraw this 10,500, but you have to ensure that you maintain always this 8% margin as initial margin that is put in, right? But at all times, it can never go below this 6%. Next day, the index went up by another 140 points. So you made a profit of 7,000 rupees on the contract. Not your profit is not 7,000. The profit on the contract is 7,000, right? So this 40 with 7,000 plus 7,000 makes it 54,000. So your margin account keeps on increasing. Right? Why is it increasing? Because you agreed to buy something at 9170. Already the market is at 9520. So you made a gain. Right? Likewise, on third day, the entire thing went ulta. What happened? From 9,500, it fell to 9,100. So you made a 420 rupees loss per contract, and you have 50 lot. 50 is the lot size. So 420 into 50, you made a loss of 21,000 on the entire contract value. So that 21,000 has to be subtracted from 54. Then you'll get 33. Now is when you compare this with the margin, maintenance margin. You are required to maintain 6% maintenance margin, correct? Now, if you look at this, 9,100 into 50 into 0.06, you will basically get 27,300. So even though the margin has come down, that is the loss, 54,000 minus 21,000 of loss has come down to 33,000, you are still above the minimum margin that is required to be maintained of 27,300. So you are safe. Next day, index fell further. It fell another 140 points. So you made another 7,000 loss. Now, this 33,000, whatever you had, is reduced by 7,000. So 33,180 minus 7,000 will give you 26,180. So it became 26,180, right? But how much are you required to maintain? You are always required to maintain 8,960 into 6%, right? That is 8,960 into 6%. That comes to, no, your 8,960 into 6%. How much is it? 8,960 into 50 into 0.06. That is 26,880. You are supposed to make, you cannot go below 26,880, but you've already fallen to 26,180. Where is this 26,180 from? 33,180 minus 7,000 loss. So you've basically fallen below the maintenance. If you fall below the maintenance margin, you have to come back to initial margin of 8%. Right. So what is the initial margin? 8% you have to maintain. 8,960 into 50 into 8960 into 50 into 0.08. That comes to 35,840. So you have to bring it back to 35,840. Why do you have to bring it back to entire 8%? The margin, your margin balance is 26,180, but you're at minimum, you have to maintain 26,880, right? You are 700 short. Because of the 700 short, you have to come back to entire 8% full, right? So you have to bring it back to this 8% initial margin level. So you have to deposit this much money. How did I get 9660? 35,840 minus 26,180, which is my margin account value. So the difference is 96,660. If I add this 9,660, it will come back to 35,840. Like that, you actually have to recoup the margin. And finally, what happened? The stock ended up on the last date 9140. So it went up by 180. So 180 into 50 is 9,000. So this 9,000 gets added to your 35,000. It becomes 44,000. Right now, if you look at the entire story, right, you have MTM loss here. MTM gain, loss, gain. So this MTM, right? This MTM is basically the marking to market of each and every contract. So this contract on every day basis, whatever is the gain or loss on the contract is actually accounted for. That is what is called by marking to the market. So you have marked this to the market and you have summed up all of these. Basically, your net loss is 1,500. If you look at it here, what is the closing margin account? Initially, you had margin, you deposited 36,680. Closing is 44,840. So 44,840 minus 36,680 minus 9,660. Why 9,660? You deposited that also. So if you do this, then you'll get that the value is 1,500 of loss. 44,000 minus 36,000, you'll probably get 8,000. Minus this, you'll actually get 1,500. So you'll get 1,500 loss. This, you sum up the entire MTM losses, you'll get 1,500. Or you sum up the change or the entire change in the margin account, you'll get 1,500. Either ways, you will get you've made a loss of 1,500. It is just a different methodology of computation, but both of them will give you same answer. There is another way to compute this. What is the another way? Your 9170 is the original price, 9140 is the ending price. So you basically made a loss of 30. 9170 minus 9140. You've gone long, right? That is what they said in the question. In the question, they've said net profit or loss, person who has taken a long position, right? So on 9170, you purchased, it fell to 9140. So you made a loss of 30. 30 into 50 is the lot size is 1,500. So that is also 1,500. So either ways, you can use whichever method, but eventually you will come to this loss of 1,500 and mark to market. These are all mark to market. You sum up all the MTM gains and losses, you'll end up at this 1,500. So this is the first example. Second example is on hedging, right? What is this hedging? See, we said if let's say a petroleum company or Infosys or somebody basically has an exposure, they go and hedge. But in case of stock markets, if somebody already has a portfolio, then they can hedge that particular portfolio, changes in that portfolio or risk to that portfolio by entering into future contracts. Let us see that. Mr. X is a senior portfolio manager at ABC Asset Management Company. He expects to purchase a portfolio of shares in 90 days. So he does not have the shares today. He wants to buy something in 90 days. However, he is worried about the expected price increase in shares. So he thinks after 90 days, the price may go up, right? And in order to hedge against this price increase, he decides to take a position on 90-day forward contracts on the index, right? So he wants to buy some shares, but he is wanting to hedge the shares using the index. Somebody has a question, 1 minute. Yeah, students, you have any doubts? Please feel free to ask. If you want, I can unmute as well. Fair enough. I've not got anything. Anytime you have any doubts, please feel free to post. Right. So let us come back to this particular question, what we were discussing about. Right. So this gentleman has X, he is going to buy shares, and he wants to hedge it using futures of index or forward. I'm sorry, not future, right? He said forward, hedge using index forward. Okay, now what are they saying? The index is currently trading at 2290. Assuming that the continuously compounded dividend yield is 1.75% and the risk-free rate of interest is 4.16%, you are required to determine the following. What are you required to determine? calculate the justified forward price on this contract. Okay, and if at expiration date of 90 days, the index value is 2470, what will be the gain on this long position? And take 365 days in a year and value of years so and so. Now let us understand this. What are they saying? Calculate the justified forward price of the contract. So this is very, very simple. They are saying currently the index is 2290. Okay, then they've given this as Y. Y is dividend yield. This is R. Then what have they said? The time is 90 days. This is also given. Then this is S0, right? S0 is there, T is there, R is there, Y is there. They have said for this, find out the forward price. So forward and future price is same, right? Forward is S0 into E power R minus Y into T. That's all, as simple as that, nothing else. Then what is the second point? If at the expiration date of 90 days, the index value is 2470, what will be the gain on the long position? So friends, in our case, this man wants to buy some shares. On those shares, he may have a loss. So hence to hedge for that particular loss, he is entering into a forward contract, right? So on index, okay. So he is basically trying to, from whatever is today's index value, the today's index value is linked to the existing stock prices, right? Or the existing stock prices and today's index value, there is some beta, right? He is saying, or what he wants to do is, I will enter into this contract based on today's index price. Whatever are the changes that happen to the index will get reflected in the stock prices 90 days later. When I buy the stocks on 90th day, at that time, all these changes will get reflected, whatever is the gain or loss in the future contract that I have today, that I've entered into today, that will get added to the stocks that I will purchase after 90 days. And theoretically, I have logged in today's price. So this whole exercise is to ensure that the investor is locked, L-O-C-K, locked in today's prices of the shares by entering into a futures contract on index. Now, let us come to the solution for this. See, they have said that the spot is 2290. Tenure is 90 days. Dividend yield is 1.75. Risk-free rate is 4.16. So far, so good. What is forward price? Spot into E power R minus 5 into T. And here, T is 90 days. So you have to do 90 by 365. Okay. So if you do that, you will basically do R. This is R minus Y. And this is into T. Right. Let me just delete this. E power R minus Y into T, and T is represented in year forms, right? And they've said very specifically, take 365 days in a year. So what we are doing, we're doing 90 by 365. So 4.16 minus 1.75 into 90 by 365. So if you solve this 2.41% into 90 by 365, you'll get 0.0059425. Now, if you look at this, they have given 005942. For that, they have already given the E value, which is 1.005960. So here they have not given the last decimal 5, but that is okay. You got 59425. They have given for 5942. You can take this value. It doesn't matter. So 1.005960. You directly take this value 2290 into 1.005960. Correct? That is what they've given. Yes. If you do this, you will get this as the answer. So 90-day forward price is 2303.65, which is your spot multiplied by E power R minus Y into T. Right. So this is the 90-day forward price. Now, what is the second part of the question? Second part of the question is, if at expiration date on 90 days, index value is 2470, then what will be the gain on long position? So if the index value is 2470, after 90 days, you have entered into a forward contract at 2306. The index is now at 2470. So obviously you made a gain because you've entered into contract at a lower rate, whereas the future contract is now at 2470. So you made a gain of 166.35. How did you get 166.35? 2470 minus 2303.65. What is this 2470? They themselves have given, no? At the expiration of 90 days, index value is 2470. What will be the gain on the long position? So you take 2470, subtract this forward price from that, and you will basically get the gain that you made on this particular contract. Okay. Now there is one more query which some student have asked earlier in one of the interactions I've had. What if the value of E power X is not provided, friends? So typically ICA does provide. Okay. Typically they do give what is the value of E power X. In case they don't give. In case they don't give, and I told you E value is 2.7182. So E value is known, but how do you compute E power 0.05? In the previous example, they have given e power 0.005942. If they don't give this, what will you do? So one way to do it is, if you remember your CA foundation calculator tricks, if one has to find out the value of a power x, in our case, it is e power x, right? What you do is you enter 2.7182 in your calculator, then press the square root button 12 times. So basically you're doing it 2.7182, you're doing square root 12 times. So that is 2 power 12. That is, you are finding out 4096 root. Okay, you press the square root button 12 times, whatever is the resultant number. If you want, I can actually do it in along with you. 2.7182. 2.7182. Okay, then I find out the square root. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So you will get something called 1.00024 something, right? Subtract 1, minus 1. Okay, you will get some value. Then multiply the resultant with the exponent that you want, that is power of. Here we want to find out the value of e power 0.05. So you multiply whatever is there on your calculator into 0.05. You'll get another value. To that you add 1. Okay, then you do into equal to 12 times. Here we took 4096 root. Now you are arriving at, squaring it so many times so that you negate the impact of this. So you do into equal to, 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 so on and so forth. You do it 12 times. Eventually you'll get a value which basically equates to 1.0051 or something like that, right? So you will get this particular value if you were to follow this entire process. Okay, so this is one way to do it. Typically in exam they will give you, if at all they don't give you, you have to follow this process. Okay, it's a part of the calculator tricks that you probably would have learned it in foundation. Now coming to arbitrage, right? So this is another variety of questions that they will ask. Calculate the price of 3 months PQR futures. If PQR face value is 10 rupees, quotes at 220. So the current market price is 220 on NSE, and the 3 months future price quotes at 230. So future is 230. Okay, and 1 month borrowing rate is given as 15%. So R is equal to 15%. And expected annual dividend is 25% per annum. 25% per annum. Dividend is 25% per annum. Okay. It is not dividend yield. Okay. Please note, this is not dividend yield. Dividend yield is, what is dividend yield? Dividend yield is dividend by price of the stock. That is dividend yield. Here they have given 25% is the 25% of book value. That is 2 rupees 50 paisa. Book value is 10 rupees, no, not book value, I'm sorry, 25% of face value. 25% of face value. So 10 rupees into 25%, 2 rupees 50 paisa, that is the dividend. Okay, so this dividend you have to convert into yield. How will you convert? 2.5 divided by 220. This is one way. You will get 2.5 divided by 20. 220. You will get probably 0.01136. That is 1.136%. You can either do this, or you can directly take the dividend value of 250 and adjust it. Let us see how this works. So what are they saying? Calculate the price of a 3 months PQR future if it quotes at rupees 220 on NSE and 3 months future price is 230 and 1 month borrowing rate is 15%, expected dividend is 25%, payable before expiry. Also examine the arbitrage opportunities. So let us see. See, current spot is 220, 3 month future is 230, borrowing rate is 15%, expected dividend is 2 rupees 50 paisa, as I said. Then theoretical price of the future is cost of carry plus spot plus cost of carry minus dividend. So one way here, I'm not using e power because in this particular problem they've not given e. So probably they're expecting us to use normal compounding or some kind of simple interest method. They will specify what they want. The same problem you can solve using e also, where I've explained to you how using e we can compute if the value of e power x is not given. Here I've solved it by simple interest method because the reason is I want to explain to you guys how this is done. More than the whether E is not done or not, E is used or not used, I actually want to explain to you how this process works. So 220 is the spot. Cost of carry is 220 into 15% into 3 by 12. Why 3 by 12? Because it is a 3 month future, right? 3 month future. So 220 into 15% into 3 by 12 minus 2 rupees 50 paisa. What is this minus 2 rupees 50 paisa? The dividend that you will get at the end. dividend that you'll get at the end that you are subtracting. So you are basically following this formula of spot plus cost of carry minus dividend. This can also be e power r minus y into t. You can do it that way also. But here I've done it on simple interest just for you to understand this whole process. So if you do based on this, you are getting 225.75 as the future value. But the 3-month future is quoting at 230, whereas the future is currently only 225. The theoretical price, this is known as theoretical price. And this is known as market price of future. Future is trading at 230, whereas the actual theoretical price, what you compute is 225.75. So what are you supposed to do in this kind of a situation? Why? So somebody asked, first question, sir, why dividend not for 3 months, sir? I'm sorry, I didn't understand. What is it that they said? So here they themselves have said 25% per annum payable before expiry. Payable before expiry. So what has happened is, in this particular problem, they themselves are saying that this 2 rupees 50 paisa, whatever is the dividend value, is going to be paid in next 3 months. Is going to be paid in next 3 months. That is why we are considering it like this. So that was I've answered your question, Rati Vigneshwari. You've said that why is it that we are not taking dividend of 3 months only? That is 2.5 into 3 by 12 or something. That does not apply because they themselves have said 25% per annum payable before expiry. So it is definitely going to be paid in the next 3 months, right? So which is why you are subtracting the dividend value. You got this 225.75. Right. Now, market price is 230, whereas the theoretical price is 225.75. So what are you supposed to do? So I told you, right? I'll explain to you this whole entire process. So on day zero, this is cheap, this is costly, right? The way to look at it is this. So if the theoretical price is lower, and the future price is costly, right? What do? You basically sell future. That is this. The market price is 230, right? It is costly. Whatever is costly, you sell. Whatever is cheap is you buy. So in this case, you sell the future. Once you have sold the future here, you have to enter into corresponding activity, or rather linked transactions to negate the effect. So let us see what are those transactions. You first sell futures at 230 because it is costly, you sold it off. When you enter into a sale transaction for future, there is no associated cash flow. So the cash flow is zero because future is just a contract. The day you enter into contract, assume that there is no margin business and all, you don't have to deposit any money. So if you don't have to do anything, then the associated cash flow is zero, right? Then what you do is, because you are selling something, you also have to buy something, right? Here you are selling something. What you do is, you borrow money from the market at 220 rupees, 220 at 15% and invest it in the spot market. That is, you borrow at 220, invest in the stock, right? So the stock is currently trading at what? 220 rupees. So you borrow 220 at 15% and buy the stock. You borrow 220 at 15% and buy the stock. So when you borrowed, you got plus 220. When you invested in the stock, you basically gave 220 rupees to somebody and you got the stock. So there is a cash outflow. This inflow outflow get knocked off and your cash flow on day zero is zero. Then after 91 days, what will happen? On the future date, what is supposed to happen? Right, you have sold future, right? So what do you mean by sold future? On a future date, you have agreed to sell to somebody something at 230. So when you sell something to somebody at 230, that somebody will give you 230 and you have to give that something to them. So what is that something? The stock. So you give the stock to them and take rupees 230. So you deliver the stock against the futures and take the cash. So you take 230 rupees and you give off the stock. Now you basically purchase the stock. That stock you are now giving delivery here. Now what happens? You have to still repay the loan. Out of this 230 rupees, you repay the loan of 220. You took a loan, right? You took a loan of 220. That 220, you repay the loan, right? But you also have to repay interest. How much is the interest? 220 into your 15% into 3 by 12 or 91 by 365. You do whatever, you'll get around this 8.25. So you 220 minus 220 along with the repayment of principal, you're also repaying interest. And then you're also getting a dividend because you own the stock. See here, you said you have owned the stock, right? I said you invest in the stock, you purchase the stock. So because you have the stock, that particular stock will give dividend and dividend will come to you. So you have a cash inflow of 2.5. So you have a cash inflow of 230, then you have a repayment of 220, then you have interest payment of 8.25, then you have a dividend inflow of 2.5. The net effect is 4.25. So 4.25 is the gain that you will make. Now, what is this 4.25? If you were to think clearly here, this 4.25 is difference between 230 and 225.75. Right? This is the actual price and this is the theoretical price. So without taking any risk, you have a stock, you also sold future. So basically, if at all the future date something happens to this stock price and or something happens to this future, something happens to the stock price, you can actually, you'll make gains or losses on futures which will offset the stock price gains or losses, right? So which is why you've basically taken a riskless position and you've earned 4 rupees 25 paisa. What will be a risky position? A risky position is where you basically directly go long on future. This particular 3-month future is trading at 230, right? So you basically for 230 is the current market price, whereas the theoretical price is 225.75. If you want to take a risky position, what you will do is you will sell the future, right, and keep it open, and on that day the market will come down to 225.75. Since you have sold at 230 and the market price is 225.75, you will basically make a gain of 4.25. That is a risky way. This is a non-risky way. Why is this a non-risky way? This is a non-risky way because your gains and losses in stock will get offset by gains and losses in futures. So you're entering into back-to-back transactions, so that all your gains and losses on stock are hedged by your particular transactions in futures, and you're doing all of this by borrowing some money at 15%, right? So this is the way in which you basically make a riskless profit of 4.25 when your current market price is higher than your theoretical price of 225.75. Same thing ulta will happen if the current market price is 220 and theoretical future price is 225.75. You will enter into exactly opposite transactions, and there also you will make the difference between these two, 225.75 versus your 220, whatever is that 5.75, you'll make a gain. Okay, now after having understood this particular problem, any more questions anyone has? I would want to take them. Somebody's asked a question. Raj Kumar Badam, is it possible to cover CPPA topic in portfolio as well? What is CPPA topic? I have not understood. Raj Kumar Badam, please elaborate your query. Okay, so in the meanwhile, let me continue with the next part of the thing. Next kind of, so we'll conclude this entire futures thing with this, right? I think we can conclude. Yes, we'll conclude the entire futures discussion with this. This is the next illustration, which is portfolio beta, right? So if you remember, guys, there was one place where I said that if you have to hedge a portfolio using index, then number of index futures is equal to portfolio value into portfolio beta. So we will use this particular philosophy or this particular formula in this particular problem. So let us see what is the problem. Mr. A has a portfolio of 5 crores consisting of equity shares of X Limited and Y Limited with beta of 1.15. So the portfolio beta is 1.15. Other information is as follows. Spot value of the index future is 21,000. Multiplier is 150. There is lot size. They sometimes call it as multiplier. You need not consider that. Lot size is the right way of calling it, but even if they give multiplier, you need not get confused by it. So multiplier is 150, right? Now, what are they saying? You are requested to change the beta of the or reduce the beta of the portfolio to 0.85 by doing two things. One, change in the composition through risk-free securities or by using index futures. So let us see what is this. Portfolio value is 5 crores. Portfolio beta is 1.15. Index futures current price is 21,000. Correct. Lot size is 150. That's what they've given. Yes. This is the data that is given. Now we are supposed to compute two things. First one is reduce the beta of portfolio to 0.85 by changing the composition of the portfolio using risk-free securities. This can be done. Yes. Or reduce the beta of the portfolio to 0.85 by entering into index futures contracts. Let us see how both of them are done. First one is reduce portfolio beta using risk-free securities. So friends, one of the things that you have to notice, risk-free security beta is equal to 0. Risk-free security beta is 0. So if let us say, the portfolio is 1, right? Portfolio, let us say the entire portfolio, 100% is the value of the portfolio, and we let's say call it as 1. Then portfolio value into portfolio beta is equal to the value of equity shares into beta of equity plus value of risk-free into beta of risk-free. This is the portfolio beta formula, right? So portfolio value into portfolio beta will actually be a summation of equity value into equity beta plus risk-free asset into risk-free asset beta, right? So what are they saying? They are saying portfolio beta should be 0.85. Right. So these are all where I've actually taken weights of, value of equity and value of risk-free asset. So if you were to consider the overall portfolio value is 100, then risk-free asset, let us say, is RF, then equity portfolio value will be 1 minus RF. Basically, there are two components here. They said X and Y, right? So let us not take X and Y. Let us take E and R. So E plus R is equal to 1. Right. So R is equal to 1 minus E, or E is equal to 1 minus R. Correct. So what we have done here is portfolio beta of 0.85 is equal to 1 minus risk-free. That is, this is what I've done. 1 minus risk-free into 1.15. Why 1.15? 1.15 is the portfolio beta, existing equity portfolio beta, right? So existing equity is 1 minus RF, that is the weight of that particular equity shares, multiplied by 1.1F, and risk-free asset has a beta of 0, right? So 1.15 into weight of equity shares plus risk-free weight into the beta of risk-free asset. Beta of risk-free asset is 0. The total average, weighted average beta is 0.85. If you were to solve this particular equation, you'll get 0.85 is equal to 1.15 minus 1.15 RF. And if you solve this further, you'll basically get a risk-free assets is equal to 26.09. Now, our existing portfolio value is 5 crores. But they are saying 26.09% should be in risk-free assets. So if you multiply 5 crores into 26.09, you will get 1.3045 or something like that. So 26.09 into 5 crores is equal to 1.3045 crores. So what they are basically saying is, or what you're supposed to do is 1.30 crores, 1.30 crores out of this entire 5 crores should be withdrawn. It is, you have to sell securities of X and Y to the extent of 1.3 and invest it in risk-free securities. And when you invest in risk-free securities, they have a beta of 0. The balance assets, right? The balance assets, which is what, 3.7 crores, they will have a beta of 1.15, and the weighted average beta of this will be 0.85. How? Because this risk-free asset is how much? 1.30 crores, right? So 1.30 crores into 0 plus 3.7 into 1.15, whole thing divided by 5 crores, you will basically get 0.5. So you have to divest, or rather divest 1.3 crores should be taken out of X and Y in their respective weights. We don't know how much is X out of 5, how much is Y out of 5. So we'll take whatever the weights, you take X and Y, you divest, you basically sell off 1.3 crores worth of X and Y in whatever ratio they were there earlier, and invest in risk-free securities to reduce portfolio beta to 0.85. The thing to note is risk-free securities beta is 0. And the weighted average computation is what? Beta of portfolio is equal to weight of equity into beta of equity plus weight of risk-free into beta of risk-free. Now, this can be written as weight of equity can be written as 1 minus weight of risk-free, right? So 1 minus weight of risk-free into beta of equity plus weight of risk-free into beta of risk-free. This is the beta of portfolio. and this beta of risk-free is 0. So this entirely becomes 0. This whole part of this particular expression becomes 0. So beta of portfolio is 1 minus beta of risk-free rate into beta of equity. So if you solve for this particular thing, you'll basically get the answer. That is exactly what we have done here, where we said 1.3 crores should be taken out of X and Y. Now coming to the next part. How can we hedge the same, or how can we reduce the beta to 0.85 by using futures? How can we reduce this beta to 0.85 using futures? So there also what you can do is future contract, just like beta. What I said, beta risk-free asset has a beta of 0. Future contract has beta, but the contract value is 0. See, on the day you enter into contract, no, the contract is just a piece of paper. The paper does not have any value on that day. You may generate returns out of it. I'm not saying no, but the beta of that particular contract will be 1 because it is market link contract, right? They said index futures, right? So the beta will be 1. It has a beta of 1, but its value is 0. So what happens is the same formula. What will happen is beta of portfolio is equal to weight of equity into beta of equity plus futures, weight of futures into beta of futures, right? So if you were to solve this particular equation, right, you will get the answer. So let us see what it is. 0.85 into 5, right? 0.85 into 5, that is the value of the portfolio beta. 5 that is product of portfolio value into portfolio beta is equal to 5, which is the existing equity, into 1.15, which is the existing equity is beta, into value of the future contract into beta of the future contract, right? Because it is an index future, the beta is 1. So if you were to solve this, you'll basically get future is 1.5 crores. So basically future value is 1.5. So here, please note, I have used minus. I have used minus. Why have I used minus? Because your existing portfolio has a beta of 1.15. If you have to reduce beta, right, you will short. You will short futures. You will short futures, right? If you go to long on future, what will happen? 1.15 plus 1. So this number will always be greater than 1. It can never be less than 1. However, if you were to short, right, if you were to do something here negative, then the value will come down below 1. We want it at 0.85, right? So it will come down below 1. So the notional value of futures contracts that you have to short here, F is 1.5 crores. Note all these terms are crores. Right, so 1.5 crores and the value of the index is 21,000 and number of lots is 150. You divide 1.5 crores by 21,000 by 150, you'll get number of futures contracts to be shorted as 4.76. Right, so this is the other variety of problems that you can get, that you can be asked in the exam. Any other question that you have? Any other question that you have? No, so far none. Okay, so this is the other variety of questions that can be asked in the exam. Obviously, as I said earlier, I've not covered every single variety that is possible because in a very short span of 1.5 to 2 hours, I cannot cover all of them. But I've tried my best to cover to the extent possible. Now, this finishes futures. Let us go to options. Right. Now, coming to options, let us understand what is an option. There are 2 types of options basically. One is called as a call option. Second one is called as a put option. A call option is a right to buy. It is a right to buy a specified asset at a future date at a specified price. That is, just like a future contract, you are agreeing to buy something at a future date, at a future price. But there is one big difference. It is a right to buy. In a forward or future contract, it is a obligation to buy. Whereas here it is a right. That is, you have a right, but no obligation. That is, you have a choice. Have a choice. So a call option is basically an option that is at your choice. You can choose to either buy or not buy, right? So that is a call option. What is a put option? A put option is a right to sell. Okay, you have a right to sell at your choice. That is, if you want to sell, you can sell. If you don't want to sell, you will need not sell. But the terms of the agreement are determined, predetermined. That is, of a specific asset at a future date, specified date, at a specified price. So all these 3 are predetermined. On that day, you can choose to either exercise. That is, you can choose to go ahead with the contract, either to buy or to sell. If it is call option, it is buy. If it is put option, it is sell. You can choose at your convenience what you want to do. Give me a sec, guys. I'll have some water. Okay, friends. Now let us go to the next part. I want to explain these two in slightly greater depth. Okay. What are the key terms in options? The value of a call option is called C. The value of a put option is called P. Okay. Call option is usually when we say value, this is the premium. What is premium? I will explain. I will come to that. But first, let us just understand these terms. Then K is something called as a strike price. Strike price means, here I said, a specified asset at a future date at a specified price. This is strike price. And the strike price is denoted either by K or X. Okay. Then present value. This is basically just like the way you have seen future contract is future value, e power RT is future value, e power minus RT is present value, right? So this is the present value concept that is used in options. S is spot price. The spot price is current spot price, right? Just like F is future price, S is spot price. And in this particular options, we don't use future price. Rather, we use this thing called strike price, which is denoted either by K or X. Then we have something called as time value, intrinsic value, American option, European option. I'll come to them. We will discuss these four as we move along. First, let me explain this particular option in slightly greater depth, right? Let me say, yeah, let me first go through this buy call and long call, then you'll automatically understand. See, let us say I have a right to buy some asset. Let me say share of RIL. Okay, RIL, one share at 2,100. I have a right to buy RIL share at 2,100. And in order to have this right, that is, I want to buy this at 2,100 after 3 months, after 90 days. Okay, I am entering into contract with you to buy this share of RIL, one share of RIL at 2,100 after 90 days. You will say, if I say, if I come to you and say, please, let us enter into a contract where I want to buy this at 2,100 after 90 days, you will say, what is in it for me? You'll obviously ask that question. Why should I do this? So what I will offer you is, I will say, I will pay you something called as premium. I will pay you 100 rupees premium. Okay. You keep this 100 rupees and after the future date, you allow me to buy on this 90th day. On this 90th day, you allow me to buy. Now you see, I have initially paid you 100 rupees. So if you look at my side, that is, I am buying the call. When I say buy call, long call, I am the one who has a right to buy, right? I am long on this call. So when I'm long on this call, on the first day itself, I've paid you this 100 rupees. So for all scenarios, I am actually out of money. That is, I am short. That is, my money has gone out. Cash outflow of 100 is there from my side. So till 2,100, I actually don't bother about this contract. But moment, let us say it comes to 2,400. Okay, let's say the stock price on 90th day is 2,400. See, on that day, I can buy from you at 2,100 and sell in the market at 2,400. How much profit have I made? I made 300 profit minus premium. I have already paid you 100 rupees premium. So my net profit is 200. So if you see, if the market price is 2,400, I have made 200 rupees profit. If market price is exactly 2,100, I'm still 100 rupees loss only. But if the market is 2,200, I will get the difference between this 2,200 and the strike price. What is the strike price? 2,100 is the strike price. The difference between the spot and this particular strike price on that day, right? This money I will get as gain. But this gain, I've already paid. This gain is how much? 100 rupees. Out of that, I've already paid you 100 rupees as premium. So my actual gain or loss on that day is 0, right? But as the price keeps on increasing, my total profit keeps increasing. You see, this is my profit. This is my cost. This is my net profit, right? So premium is your cost. Your profit is this. This is the net profit. Now you see the other side. If let us say the stock price falls to 1,700, what will I do? I have a right to buy from you 2,100. Will I come and buy from you 2,100 and the market price is 1,700? I'll say, chalo boss, I'll buy in the market at 1,700 only. So because of entering into this option, I have saved this money, because had I bought it today itself at 2,100, after 3 months, suddenly the market price is 1,700. I have lost 400, right? But because of entering into this option, I now can buy it at a lower price of 1,700 by just losing only 100 rupees instead of this 100 rupees instead of losing 400 rupees. So the option gives you a right, it gives you a chance, it gives you a benefit. Basically, by paying a premium, small premium, you have a right to buy or sell something at a future date at a predetermined price, and that too at a specific future date, right? This is a long call. Now, what is a short call? See, when you do a long call, right, you are going long, you are buying a call. When you say short call, you are selling a call. That is same thing ulta. So this one I wanted to buy and you were the seller. You now inverse the position. Here I want to, this entire thing is from your perspective. That is, somebody else wants to buy from you. Okay, it is not a contract to sell, it is a contract to buy. Somebody else has an option to buy from you. Sell call is somebody else has an option to buy from you. So on day 0, you get the premium. This is 100 rupees. So till the time the price is 2,100, the other person will not exercise the option. We saw just here, right? The person is going to exercise the option only after 2,100. At 2,200, it is break even. After that, it is profit. So exactly ulta happens. That is, let us say you have, the other party has a right to buy. You have taken the premium, then you are getting this 100 rupees. Till 2,100, the other party is not going to do anything. But moment it comes to 2,200, that party is going to break even. So when whatever profit he is making here, right, that is the loss that you will make it here. Okay, so and whatever loss he is making here is the profit that you are making here, right? So a sell call is exact opposite of buy call. Please don't get confused. Call and put are not opposites. If you buy a call, you have to square off the position, you have to sell a call only. If you buy a put, to square a put position, you have to sell a put. But you cannot buy a call and square it off by selling a put. No, both are different contracts, right? Contract. Okay. If you buy a call, in order to close the contract, you have to sell a call only. If you buy a put, in order to close the contract, you have to sell a put only. Okay. Now coming to I don't think I've explained this part. Let me explain this. What this is what is the value, or rather what is the benefit or net payoff? Okay, let me clean this up. What is the net payoff of this particular contract? See, you have, I'm telling you with respect to a buy call. That is, let us say you have entered into a contract to buy something at 2,100 a future date by paying 100 rupees. So on day 0 itself, you are minus 100. Now, in this particular kind of a contract, what is your payoff? That is, what payoff means, what is your profit? Your profit is, as and when it crosses 2,200, you'll start making, as and when it crosses 2,200, you'll start making money. So how do you put that in an equation form? What you will do is, whatever is the spot price on expiry date is the date on which the contract will mature. Here it is 3 months. On that day, whatever is the spot minus the exercise price. Right. So let us say on this day, the spot is 2,200. Exercise price is 2,100. So the difference between these two is 100. So your profit on that day is max of 0 or 100. Right. So this 100 again will get reduced by your premium of 100. So it will become 0. Ignore the premium for a moment. The payoff is basically your spot minus exercise price. Let us say the spot is 1,700 and exercise price is 2,100. This becomes minus 400, correct? So max of 0, minus 400. What is the max of these two? 0 is max. So on that day, your payoff is nil. That is, the initial 100 that you paid off is gone, but fresh losses or gains from this contract are nil for you. But if the price moves up beyond this 2,100 level, you start making money. So max of 0, spot minus exercise price. Also note one more thing, friends. In case of all buy calls or buy put, it is a max. Buy call or buy put is max. Okay. Sell call or sell put is min. Okay. So this is minimum of X. What is the strike price? 2,100 minus what is the spot? Spot is 2,400, 0. So minimum of minus 300, 0. So you'll get minus 300. So you are making a loss. So when you have sold a call, if the price keeps increasing, you are actually going to make a loss, right? So that is what is given by this formula. So as I said, the buy is always max and sell is always min. Right. Now coming to a put option. What is a put option? You have a right to sell. A put option is right to sell. Okay, you have a right to sell. And when I say put option, here it is buy put. Okay, for buy, it is always max, right? And here this function is max of x minus st. So if you see, you have a right to sell. You have, let us say, take the same example. The premium is equal to 100 and your strike price is equal to, let us say here the strike price is equal to 1900. So if the market price on the expiry date is, let's say, 1800, you have a right to sell at 1900. So you basically what is currently at 1800, you can sell it at 1900. So you basically make this 100 rupees as profit, because you can buy from the market at 1800 and sell it to me at 1900, right? So you're making this 100 rupees profit. But in order to enter into this contract, you basically have to pay this 100 rupees premium. So these both get negated, and 1800 you make a no loss or no profit. But as the market price keeps falling, your profit keeps increasing. How is that? So let us say the current spot is 0. Let us take extreme examples. So if your current spot is 0, then what happens is you have a right to sell at 1800, but the market price is 0. So you can buy from the market at 0 and sell at 1800. You're making 1800 rupees profit. But from this 1800 rupees profit, you have to subtract this 100 rupees premium. So basically, you're making a 1700 rupees profit. So this is why this particular curve goes like this. And also, please note, in case of a put option, the profits are limited. Whereas in case of a call option, profits are unlimited. Okay, and same way in case of a short sell call, losses are unlimited. But when it comes to put option, the losses are limited. So if you look at this, right, what is a sell put option? Sell put. If you see here, you have entered into a contract to what is sell put. First of all, put option is a right to sell. What is a sell put? You have sold a right to sell. That means somebody has a right to sell to you, right? You basically have, somebody else has a right to sell to you. So whenever they want, they will sell to you. So when will they sell to you? They will sell to you when the price comes down. So let us say same logic what we took earlier. Premium is equal to 100. Then spot is not spot. Exercise price is, let us say, 1900. And let's say the spot is 100. Spot comes to, let's say, 1800 rupees. Spot is 1800 rupees. Then what happens is, you basically, the person who you have sold this contract, there is a buyer of this contract. So you sold put, there is a buyer of put. So for the person who has sold, this is the payoff. It is minimum of strike price, spot price minus strike price in comma 0. That is minimum of spot price is 1800 minus 1900 comma 0. Right. So you basically make a loss of 100 rupees, but that is offset with the premium of 100. So you basically make a net loss of 0. But at every point below this, let us say the spot price is, let us say 1500, or let's say 1400. The spot price is 1400, then it is minimum of 1400 minus strike price of 1900 comma 0. Right. So this will be minus 500 comma 0. So you'll minus 500 is your loss. And the initial premium that you got is 100. So net loss is equal to minus 400. So at the price of 1400, you'll make a net loss of somewhere around here, which is minus 400. So that is how these contracts are structured. That is, a sell put is a right. You have sold a right to somebody so that they can sell to you. A buy put is you have a right to sell to somebody. A sell put is somebody else has a right to sell to you. A buy call is you have a right to buy. A sell call is somebody else has a right to buy. Okay. So please, if you understood these 4 things, right? What is buy call? What is sell call? What is buy put? What is sell put? Believe me, you understood half the story. And even, I mean, these numbers, right? This max, min, and all of that. Honestly, if you ask me, you should remember the logic, not the formula. If you remember the logic, you'll automatically understand. So, but one thing I want to highlight is it is max for all the buys and it is min for all the sells. If you remember those 2 itself, you'll understand most of it. Right. Now, after having understood this, I said I will also teach you a couple of more concepts, which are these time value, intrinsic value, American option, European option. So first, this American and European. American option can be exercised anytime before expiry. European option only at expiry. Right? American option can be exercised anytime before expiry. So if you look at this, I told you on 90th day something happening, and on that day you do something. So I was always very, very specific that on future some date something will happen. That kind of an option which can be exercised only on expiry or only on maturity is called as a European option. An option that can be exercised anytime before expiry is called American option. Typically, most of the contracts are European only because American options are very, very difficult to price. Okay, this is the first one part that is done. Then time value and intrinsic value. See, when you look at the premia, right? Premia is equal to value of the option. Okay, value of option. Please remember this. And in this, value of the option is equal to time value plus intrinsic value. Now, what is intrinsic value? Intrinsic value is equal to difference between spot on the date of contract and the strike price, X or K, you can call strike price. So whatever is the difference between these two, right, that is called as intrinsic value, right? So time value is the total value of the option minus the intrinsic value. So time value is actually a derived number. Time value is a derived number. Total value you can arrive. Intrinsic value is purely differential between the spot on the date of the entering into contract and the the strike price on the date of the contract. The difference from the difference of value, total option premium minus intrinsic value is your time value. So value, full value minus intrinsic value is equal to time value. Now, what is this time value? So let me explain this further. I think I'll explain it here only. So time value is basically if you have an option that is option 1 year later, 1 year is the maturity. Okay, current spot current is 100. The exercise price is 120. Okay, so for an option like this, right, the minimum value, that is I have a right to buy it 120 when the spot is 100, right? So let us say this particular option has value of, let us say, some 10 rupees. Okay, in this 10 rupees, see, already the market is just 100. I want to buy it 120. What is the chance that it will go to 120 and beyond? Why is that important? Because I as a buyer of this option will have value only if the price goes beyond 120. Only then I will exercise this option. So if I am going to exercise this option only beyond 120, the option is basically worthless as long as the spot price is between 100 and 120, correct? If that be the case, then is it never possible that the price will go beyond 120? No, it is definitely possible. Why? The stock prices are volatile and the stock prices will move up, and there is some amount of volatility because of which the price may go beyond 120. So the price of this option, let us say, is 10 rupees. Here, intrinsic value is almost zero. Why? Because the difference between 100 and 120 is actually a negative number, right? So the intrinsic value does not exist here. But let us say in the money, that is, if the spot is 100 and the strike price is 90, if spot is 100 and I want to buy it after 1 year at 90, today itself there is a value to the option of 10 rupees. So intrinsic value is 10 rupees. Let us say this option full value is 20 rupees. Then intrinsic value is 10, time value is 10, full value is 20. Right? Whereas in case of an option where it is out of the money, that is the strike price is higher than the spot. And here I'm referring to a call option. In case of a call option where strike price is higher than the spot, right? I want to buy at a price which is higher than the existing price. That price only when it comes, I will buy, right? I mean, like I will exercise the option. If the market price on the future date is 110, why will I agree to buy with this fellow at 120? I will not do, right? So in this kind of option, the intrinsic value is zero. Whereas an option in which the strike price is much below the spot price, that is today the price is 100 and I want to buy it at 90, the value of the option. Today itself, I am making a gain of 10 rupees. This 10 rupees is called intrinsic value. And let us say the full value of the option is 20. How do we arrive at this full value? We will explain later. Let us come to that. But let's say the full value of the option is 20. Then this 20 minus this 10 is called time value. This is the difference between 20 and this 10. Okay. So this is the concept of intrinsic value and time value. Now coming to the next one. So I explained to you this part, right? Which is spot price is greater than strike price. That is, strike price is below the spot price. Then it is called in the money. That is, you're already making money. If you have in the money, right, then for a call option, it is called in the money, and for a put option, it is called out of the money. Why is it called out of the money for a put option? See, I have a right to sell to you, let us say at spot, let us say spot price is 100. The strike price is 90. I have a right to sell to you at 90. Do you think I will exercise my right to sell at 90? Put is a right to sell, right? Will I exercise my right to sell to you at 90 when in market I can sell at 100? No. So this option is out of the money. That is not making any money. Whereas same if it is a call, I have a right to buy at 90 when market price is 100. So I can directly make 10 rupees. So it is in the money. That is, I am making money. So a call option when spot price is greater than strike price is in the money. And for a put option, the spot price is greater than strike price, it is out of the money. Please don't buy heart all of these. Please understand the logic. If you understand the logic, you'll be able to replicate this in a small table in the exam, and you'll actually be able to solve problems faster. Because if you don't understand this and mug this up or remember this in using some methodology, if you get confused, you'll waste a lot of time. So please don't do that. So when spot price is equal to strike price, both the options, call option or put option, they're said to be at the money. And spot price is less than the strike price. That is, spot is 100 and the strike price is 110. Then I have a right to buy at 110 when the spot is 100. So this is out of the money. Basically, I'm not making any money in a call option. In a put option, I have a right to sell to you at 110 when the market price is already 100. So today itself, I make 10 rupees. That is, there is intrinsic value of 10 rupees, right? So put option is in the money. Now, in the money options are usually costly, which is what I told you, right? Here I said this price will be 20. Here I said the price will only be 10, right? So this was an out of the money. This was an in the money. So in the money options are usually costly. In the money options are usually costly. Out of the money options are usually cheap. And at the money options are when the price, strike price and spot are same, they're relatively cheaper compared to in the money. That is, they are not, the at the money options are not as expensive as in the money, and they're not as cheap as out of the money, but they're relatively cheaper compared to in the money. Okay, now another bunch of points that I want to highlight here is how will an options value, call option or put option value, change depending on various factors. See, the option value depends on the option value. I said that, the option value, full value of an option depends on multiple things. How do we compute? As I said, we'll come later, but it depends on these things. That is, if the current market price, right, current market price is going up, then the value of the call option keeps on increasing and the value of a put option keeps on decreasing. Why is that? Let us say I have a right to buy at 100. Okay, the current market price, let us say, is 110. This is strike price. This is current market price. Now this current market price, okay, goes from 110 to 120. Will I make a gain or no? I will make a gain because I can buy at 100, whereas the market price is at 120. So I can buy from somebody at 100, sell it off the market at 120, right? So I'll make a neat 20 rupees profit. So as the current market price keeps increasing from 110 to 120, the value of my option keeps increasing, right? Same way, ulta happens for put. Now, I will not explain for put why everything happens because, then it will stretch into a very long discussion. I will, restrict myself to call. You can put is exactly opposite. You can understand it. Strike price. Now, if the strike price keeps going up, let us say the current market price is, the strike price is 100 and current market price is, let us say, 110. So if the strike price now is 120, that is, I have a right to buy at 120. Because initially I had a right to buy at 100 when the current market price is 120. Now you're saying I have a right to buy at 120 when the market price is same at 110. So why will I exercise this particular option when the strike price has gone up to 120? I am losing money, right? I can buy in the market itself at directly 110. Why should I buy at 120? So in that case, the value of a call option decreases, and exactly what happens in case of a put option. Third, time. As the time increases, right, the volatility of returns comes into play, and there is higher probability that the price will be achieved, or the strike price will be achieved. So usually as the time increases, the option prices increases both for call and put. But you have to note one thing, which is I put a star here. Let us say for very, let's say, in case of a call option, after 3 months or 4 months, let's say you've taken a 4-month call option, right? If time increases, I said option price increases. But let's say there's a 4-month call option. After 1 month, let's say there's a dividend. Then what happens? The 4-month call option is cheaper than the 1-month call option, or let's say huge dividend. Let me say huge dividend. Right, then the 1-month call option is more expensive than the 4-month call option, or 4-month call option is cheaper than 1-month call option. So typically time increases value, but in some cases where there are dividends, in that time the option, just because there is time, the option value does not increase, the option value may decrease also. For in case of put, for very long dated options and very high risk-free rates, just because there is an increase in time, the option value does not increase, option value may decrease also. Now, in case of interest, as interest increases, the call option value increases, because the formula is such e power RT, right? E power RT. It is equivalent to that thing, right? Basically, you have a right to buy. So when we see the formula, we'll understand it better. But e power RT is a very key component in this entire story. So as interest increases, the price of a call option increases and the price of put option decreases. As volatility increases, as I said, explained earlier, the price of a call option increases and the price of a put also increases. As and when dividends come into play, the price of a call option falls, whereas the price of the put option increases. Now, let us come to the most key part of this options, which is how to value these options. I told, right, full value, right? This is the value. You have these, 4 or 5 methods. One is risk neutral method, one is binomial method, one is portfolio replication or delta hedging. These both are interrelated. Then there is put call parity, and then there is Black-Scholes method. Right now, this put call parity, unfortunately, in new syllabus, they've not explained it they're not at all actually given it. It's there in old syllabus, it is not there in new syllabus. But this is something very key and important that you all need to know. I will not get into the derivation, but it just suffices to say that the price of a call option and the price of a put option are related. That is call plus strike into e power minus RT. That is present value of the strike price plus call option premium is equal to put option premium plus spot value. Now, how this equation is arrived and all that, I've explained it in my full class. You can go there and watch it if you're interested. But you need to remember this formula, because we don't know. The ICA has the habit of asking slightly related but not explain topics in the syllabus. Because this is there in old syllabus, I strongly suggest new syllabus students remember this particular formula. Okay, I will not go beyond this into this formula. I will explain these 4 methods and probably solve a problem as and when I'm explaining. Now, first is risk neutral method. Let me explain this with the help of an example. Let us say, and I'm doing here call. Most of my examples will be call. I put a put example also, but typically all my examples are call only, because it's very easy to explain. Call is a right to buy, right? So let us say today's spot. Today, the spot is 60. You are entering into a contract at 65. That is, you have a right to buy something at 65 after 1 year. Okay, period in years is 1 year. And there are 2 possibilities. This is a very simplistic scenario. That is, today the spot is 60. It can go up to 72 or it can come down to 48. There are only 2 possibilities, right? This is a very theoretical thing. The stock prices can move anywhere. But in this risk neutral method, we are considering that there are only 2 possibilities. It can go up or it can come down. So when it goes up to 72, 72 by 60 is 1.2. That we denote by a term called U. And it can go down to 48. So 48 by 60 is 0.8, which we denote by D. So 48 by 60 is equal to 0.8. 72 by 60 is 1.2. We denote this by U and we denote this by D. And they have given that interest rate is 5%. And the period for the contract is 1 year. Then if you want to do a risk neutral valuation, what you're going to basically do is you are going to equate 2 things. In a risk neutral scenario, portfolio with portfolio. Let me rephrase this. The future value of stock is equal to, right, future value of stock. This is S0 into e power RT. If you remember, assume there is no dividend. S0 into e power RT is your futures, right? Futures price. Futures value is equal to expected value. So what you're doing is future value of the share based on futures contract, what we entered, 60 into e power 5%. Where is this 5%? Interest rate is 5% for 1 year. So future value of the share, 60 into e power 5% is expected value. What is expected value? Expected value is probability into value summation. Summation of probability into respective value. So let us say the probability, since there are only two moves, right? Up move and down move. Let's say the probability of going up, P is equal to probability of up move. Then 1 minus P is probability of down move. So 72 is the up move. So there is a probability for that. 48 is the down move. There is a probability for that. So 60 into e power 5% is equal to the expected value. So if you solve for this, what you'll get is 63.08 is equal to 72p plus 48 minus 48p. So 72p minus 48p is 24p plus 48. Right. So if you were to solve this, you'll basically get p is equal to 62.8% or 62.8%. Right. So you are basically saying in risk neutral method, what you're basically saying is there is a probability that of up move is 62.8%. And when the probability of up move is 62.8%, what you're basically saying is the strike price is 65. Right. If the stock goes to 72, I have a right to buy at 65. So I make a gain of 7 rupees. If the stock goes to 48, I have a right to buy at 65. I will not exercise it. So the gain is 0. Right. So there is a 62.8% probability of 7 rupees gain. And there is a 37.2% probability of 0 rupees gain. So 7 into 62.8 plus 37.2 into 0. That will give you 7 into 62.8 is basically this 4.4. So the future value of the benefit, the future expected value of this benefit, right? Expected value of this benefit when? After at this point it is 7 rupees. At this point it is 0 rupees. This has a 62% probability. This has a 38% probability. 62 point something, right? A 62.8 and 37 point something. I'm rounded them off, right? So this is the future value of benefits. If you take the present value of the expected value of the future benefits, please note the words that I've used. Okay. Value of option is equal to present value of expected value of benefits. Right. What is expected value of benefits? I just said, right? 7 into this one. 62.8 into 7 plus, yeah, here 7 into 62.8 plus 0 into 37.18, you'll basically get 4.4. So 4.4 is the future expected value of benefit, but that is future. So you have to take present value. How will you take present value? They have given, the interest rate as something. What is interest rate? 5%. So e power 0.05, it comes to some 1.0051 or something like that. So you divide it by 4.4 divided by 1.0051 something, you will basically get 4.18. So the call premium today is 4.18. That is the value of the option. So when you say value of the option, it is same as call premium of the option, and value of the option is equal to the present value of expected future benefits after exercising the option. Whatever is the benefits, you take the expected values and then bring them to present value. That is the value of the option, which is the premium that a person will charge. Right. Now, if we were to take this particular formula, right, or rather statement, spot into a future, basically future value is equal to expected value of shares, and you simplify this, that is S0 into e power RT is equal to S0 into U. What is S0 into U? Here we got 60 into 1.2, which is 72. Right, into P plus 60 into 0.8, which is 48, right, into 1 minus P, which is this, whatever the 38% what you had, right? So this is the down move. Down move is 0.8. Up move is 1.2. So you basically put this in an equation and then solve it. You will get the probability, the risk neutral probability is computed as e power RT minus D by U minus D. Now, e power RT is a future value component. Now in exam, if they don't give you e power rt, you can compute. I've told you the method. Or even if they give you the ask you to specifically do simple interest, then instead of e power rt, what you'll do, you'll do r minus d by u minus d. This will give you the probability. You can remember this formula, or if you remember this logic, right? Future value is equal to expected value of the shares. If you remember this logic, you can also derive it. Okay. If as you solve more and more problems, you'll remember this formula automatically. So please don't get worried unnecessarily. You'll remember this formula 100%. Then next method is binomial method. Now binomial method is also based on risk neutral valuation. It is also based on risk neutral valuation. If you see here, I have drawn up and down, right? So this is basically a binomial tree, right? So let us take another example. Here, let's say the spot price is 60 and the future exercise price is 58. This is also buy. This is a put. Okay, this is a buy put. Okay, once you compute the price for a buy put, it will be the same for a sell put. Okay, because whatever, if you are paying premium and buying a put option, the premium is paying to somebody. That person is selling you a put option. So the premium that person will want is the same premium that you are willing to pay. So once you compute the premium for a put option, the same will apply for buy, same will apply for sell also. Same way for call. Now, anyway, let us come to this. They have said that it is a 2-year option, right? And the interest rate is 5%. It is an European put. You are supposed to find out the premium. The probability of up move is 1.1. Probability of down move is 0.9. So they themselves have already given it. Okay, so based on that, P is equal to e power rt minus d by u minus d, which is, if you, and they've given e value as 1.05. So what you can do is 1.05 minus 0.9 divided by 1.1 minus 0.9. What am I doing? I'm basically using this formula. So then you will get a probability of up move as 76%. How is this probability relevant? Let us see this. So initially the spot is 60, the exercise price is 58. So on day 0, the spot is 60. From there, it can go up by 1.1, right? And it can go up by 1.1. That is, it can go up to 66. From 66, it can go up by 1.1, which is 72.6. Or from 66, it can go down by 0.9, right? Or go down to 0.9 of 66, which is 59.4. Same way at 60, it can go down to 0.9 of 60, which is 54. And from 54, it can either go up by 1.1 to 59.4 or go down by 0.9 to 48.6. Now this is a put option. In a put option, in binomial method, what do? You have a right to sell. You have a right to sell at what? 65 or 58. I'm sorry, 58. You have a right to sell at 58. You have a right to sell at 58. So when the market price is 72, will you sell it at 58? No. So the option has no value. When the market price is 59, will you sell it at 58? No. When the market price is 48, will you sell it at 58? Yes, yes, I will sell. At what is the difference? At what is the gain you will make? You will make a gain of 9.4. You'll make a gain of 9.4. So in both these cases, you are not doing anything, whereas here you are making a gain. So you take the expected value of these two and bring to this node. You take the expected value of these two and bring to this node. What is the expected value of these two? 76% is the probability of up move, and 1 minus 76, which is 24%, is the probability of the down move. Right here, they themselves we've computed, right? P is 76. So 1 minus P is equal to 1 minus 76%, which is 24%. So here, this probability of down move is 24%. Now you compute the expected value for these two. That is, here the payoff is 0. Here the payoff is 9.4. So you multiply 9.4 into 24% and 0 into 76. 0 into 76 anyway is 0. So 9.4 into 24, you basically get a payoff of how much? You basically 9.4 into 24. Let me just do that. 9.4 into 24% is 2.25. You'll basically get 2.25. Okay, 2.25 is the payoff here, but you have to bring it to present value because this is 1 year away, right? So here they have said it is 2 years. So this is a 2-node binomial tree. So these are called as nodes. These are called as periods, right? So this is period 1. This is period 2. Right. So from period 2, you have to bring it to period 1. This 2.25, you have to discount it at what? 1.05. So you discount 2.25 by 1.05, it comes to 2.18. Where is this? Yeah, 2.18. You get it at 2.18. Now, at this node, you are making a net expected value of the benefit at this node is 2.18. Right. And these two nodes is 0. So this expected value at this node is anyway 0. Now coming back to this node, you work backwards. That is, you work from here to here, here to here. So here the probability of up move is 74%, right? 74 only, right? Yeah, 76%. The probability of down move is 24%. So 24 into 2.18 plus 76 into 0, because here the expected value is 0. So 0.24 into 2.18 will be 0.523. But that is the expected value here. That when you bring it back, you have to divide it by 1.05. When you divide by 1.05, you'll get 0.4989 or something like that. So you can take it as 0.5. So the put option premium, what they've asked us to find out, there is a put option premium here. Yeah, put option premium is 0.50. Don't get confused by this P and this P. This P is probability. This P is put option premium. Okay. Fair enough. We have understood this binomial method. Now go to the next one. Portfolio replicating method. What is this portfolio replicating method? A portfolio replicating method basically says, it is also very closely related to the delta hedging approach. In a call option, if you create a portfolio that is equal to the benefits from option, that is whatever is the payoff, let me not use the word benefit, payoff. You create a portfolio whose payoff equal to payoff of option, then value of portfolio is equal to value of option. So you create a portfolio which has some payoff. You create a portfolio in such a manner that the payoff of that portfolio is exactly the payoff of an option. Then the value of the portfolio is the value of the option. So this is the underlying principle. Now, what does this mean? This basically means that, just a sec, guys. Somebody is asking a question. No, there's no question. I'm sorry. Yeah. So what this basically means is you create a portfolio which mirrors the payoff and option. So if you do that, right? So if you were to do that, then the value of the portfolio will be the value of the option. So what is this portfolio that you have to create? A portfolio that you have to create will be a portfolio of shares plus cash or loan. So you create a portfolio using the shares of the stock of the particular stock for which you're computing the option price and some cash or loan. You create a portfolio of some shares. How many shares? Basically delta shares. What is delta? We'll come to it. And you create a portfolio also with the loan, some amount of cash or loan, which basically the payoff of that is equal to the payoff of the option. Then the payoff that the present value of such payoff or present value of that portfolio. I'm sorry, present value of that portfolio, PV of portfolio is equal to PV of option. Right. Now let us understand what we mean by delta shares and present value of cash or loan. What is this payoff in entire thing? Let us understand that first. But before that, I want to tell you one thing. What is delta? Delta is change in the price of option by change in price of shares. So you would have heard of this delta in economics. You would have heard it elsewhere also. Delta is delta. Delta means small change. What is the small change in the price of the option because of price in shares? So this is a ratio that is very, very vigorously tracked in the option market, right? Delta is very, very constantly monitored. So what is the impact of price of shares on the price of option? So that is the ratio. So here you are basically taking a delta shares and some cash in such a proportion such that they mirror the payoff of the option, right? So how do we do that? Let us take an example. Let us say the strike price is 65. The time is 1 year. The interest rate is 5%. It is an European call. The first year, the spot is 60. The up move, that is, it is going up S0, then SU, this is SD, right? So the up move, which is 1.1, is 66, down move is 54, right? Then the expected rate of return is the future value factor, that is e power rt, is 1.05. Then find out the value of the option. This looks very similar to what we did earlier, but I think there's some small number changes. Okay. Now, how do you do this? How do you create a portfolio which mirrors the movement in option, which mirrors the movement or changes in option price? So what you first do is you basically first take the spot. Spot is 60, right? Spot is 60, right? Strike price is 65. Now, here also you are assuming that there are only two scenarios. The scenarios are 66 and 54, right? See, when the stock moves up to 66, right? You have entered into a contract to buy at 65. Will you exercise the contract, or yes or no? Yes, you will exercise. If you exercise, what is the value of option or payoff of option? Not value. Let me call it payoff. Payoff of option. When it goes to 66, you have a right to buy at 65. The payoff is 1. When it goes to 54 and you have a right to exercise 65, the payoff is 0. Correct? So the spot on the day you enter the contract is 60, but the exercise price is 65. It can go up to 66 or go down to 54. So if these are in either of these two cases, this is the option payoff. Now you have to create a portfolio. You have to create a portfolio of delta shares plus loan, which equals the payoff of option. How do you do that? See, if you take delta, what is the delta here? How do we compute delta here? Price is 60. From 60, it has gone up to 66, and from 60, it has gone down to 54. So what is delta? Delta is equal to change in option by change in stock. So for this 12 rupees, you've got a 1 rupee payoff. So the option value is increasing from 0 to 1 when the stock price is increasing by 12 rupees. So 1 by 12. So delta is equal to 1 by 12. That is, when the stock price is moving from 54 to 66, that is, it has moved up by 12 rupees, your option payoff is changing from 0 to 1. That is, 1 is the change in the price of the option, 12 is the change in the price of the stock. So you've got a delta of 1 by 12. So here you enter into you purchase 1 by 12 shares and also take a loan. How much loan? We will figure out. Okay. We will figure that out. You take 1 by 12 shares plus loan. And when the stock price is 66, right? When the stock price is 66, you have to get a payoff of 1. And this 1 by 12 shares plus loan. And when the stock price is 54, you have to get a payoff of 0. Now, this payoff of 1 and 0, we already got this payoff from the option. Right, that is an option where you can buy at 65, you'll get a payoff of 1 when it is at 66, you'll get a payoff at 0 when it is at 54. So I'm not referring to the payoff of option. I'm not referring to option payoff. I'm saying this portfolio should generate this return. That is 1 by 12 shares of this company plus some loan. Right, and 1 by 12 shares plus some loan should generate a payoff of 1 when it is at 66, should generate a payoff of 0 when it is at 54. So if you were to substitute the value of the share right here at 66 and 54, you can formulate an equation. 1/12 of shares which are valued at 66 plus loan will give you a payoff of 1. 1/12 of a share valued at 54 plus loan is equal to 0. So you further simplify. 5.5 plus loan is equal to 1 and 4.5 plus loan is equal to 0. So what is the value of the loan? The value of the loan is basically 4.5 plus loan is equal to 0. So you take the loan on the other side. Loan is equal to minus 4.5. That is, you are taking a 4.5 rupee loan. Or you're basically the value of the loan at the future date is 4.5. You have not taken the loan at 4.5. The loan's future value is 4.5. So the present value of the loan is 4.5 divided by 1.05. Right, we've got this 1.05, they've given it somewhere. Yeah, 1.05. E per RT is 1.05. So the present value of the loan is 4.5 by 1.05. Which is basically for your 4.28. Now, if this is 4.28, what is the value of the portfolio today? Portfolio today. See, this 1 and 0 is future date. You want these payoffs on future date. Today, what is the value of the portfolio? 1/12 of shares plus present value of loan. What is 1/12 of share? 1/12 into 60. 60 is the current spot rate plus present value of the loan. What is the present value of the loan? We found out 4.28. So 5 plus minus 4.28. Loan is negative, right? So 0.72. So 0.72, right? You take a loan in such a manner or of such amount, then if you work it out, the present value of the loan and the shares is actually your value of option. So you'll basically get present value of portfolio is this, which is the value of call option. So if you have not understood this, I would request you to listen to this again. You are creating a portfolio which mirrors the payoffs of the option. The present value of that portfolio is the present value of the option. So you are taking loan as an unknown number, creating two equations, solving for the loan value, taking the loan value, bringing the loan value to present, adding the present value of the loan to the present value of the shares, and getting the difference between those two, which is the present value of the portfolio which you have, which is same as the value of the call option. Right now, if we were to do the same thing through delta hedging, what we will do is we will exactly do we will make a slight change. What is a slight change? Here we have said 1/12 of shares plus loan will give you some payoff. There we are doing something exactly opposite, or rather slightly different, which is 1/12 of a share minus a call option and 1/12 of a share minus a call option. Right? These two portfolios should give you risk-free return. These two portfolios should give you risk-free return. The value of this particular portfolio should only be risk-free return. So that is, in delta hedging, what you're saying is, you in a risk-neutral environment, basically no portfolio can generate returns that are higher than risk-free rate. So if you create a portfolio of 1/1/12 share and a call option unknown, right? You have sold a call, right? Here you have sold a call minus C. So you have sold a call. This portfolio will have some payoff when it is at 66. It will have some payoff at 54. These both portfolios will have some present values. They will generate only a risk-free return, right? They will not generate a return that is higher than risk-free return. So if that be the consideration, then what is the present value of this portfolio? You have to find out. So if you see this, 1/12 of a share minus call option, that is, you have sold a call. And when the stock price is 66, what is the value? What is 1/12 into 66? Is 5.5, and you have sold a call. 5.5 minus C. Okay, then 1/12 of a share minus C when the stock price is 54. 54 by 12 is what? 12, 4.5. Right, 4.5 minus C. Right, both of them should generate a payoff which is basically risk-free return. Which is basically they should generate you should not be able to generate return more than risk-free. How are you getting this 4.5 and 4.5 here? Just a sec, guys. I need to drink some water. Long session, throat is slightly off. Anyway, just coming back. So present value of the portfolio. What is the present value of the portfolio? Here, when you do 1/12 of 66, you get 5.5, and 1/12 of 54, you get 4.5. Right. So this particular portfolio, they should generate basically the payoffs from these portfolios should basically generate risk-free returns. Right. Now, what is the present value? The payoff here, it is 4.5. How did you get 4.5? Here, the call option, right? The call option is basically giving you a value. How much? It is giving a value of 66 minus 65, because you have a right to buy at 65. Market price is 66. You are getting a payoff of 1, right? So, what is this? I'm sorry. Yeah. So 55 minus 1, 5.5 minus 1, you're getting 4.5. In the second case, this call option will not be exercised, right? You have sold a call, right? So the other party will exercise and will make a gain of 1. So 5.5 minus 1, you basically will make a gain. Your payoff is 4.5, or the value of the portfolio is 4.5. In the second case, the other party will not exercise. So your value of your portfolio is 4.5. In both the cases, you are getting a portfolio whose value is 4.5. So the future value is 4.5. The present value is 4.5 by 1.05, which is 4.28. So the present value of 1/12 shares minus C is equal to 4.28. So this particular portfolio's present value is 4.28. So 112 shares value is 50 because current price of a share is 60. So 1/12 into 60 is 5. So 5 minus C is equal to 4.28, or C is equal to 5 minus 4.28. C is equal to 0.72 or 7197. So this is, you are just taking C to the other side and computing a payoff for that particular portfolio and trying to figure out what is the total payoff in either scenario, and then the payoff can only be risk-free payoff. So if that is the risk-free payoff, then what is the present value by considering the risk-free rate? Then you take the present value and you take that as you add that to this particular or you compute the value of this particular portfolio using the present value of the risk-free payoff. Then you will basically be able to get the present value of the call. Present value of the call will be your, or present value of the call or price of the call will be your 0.7194. So we got the same thing here also, 0.7194. If you do binomial method also, you'll get the same thing. Whatever you do, you'll get the same thing. Now, finally, coming to the last method, which is your Black-Scholes method. Now, in Black-Scholes method, friends, you need not get into the depths of how this is arrived at. Knowing the formula alone is sufficient. Okay, the price of the call is S0 into ND1 minus K into e power RT into ND2. What is ND1? What is ND2? We will discuss. Price of a put is K into e power RT into N minus D2 minus S0 into N minus D1. Right. So you're basically changing the position and actually putting a minus sign in between. And what are these D1 and what are these D2? D1 is logarithm, natural logarithm of S0 by K plus R plus sigma square by 2 whole thing into T. And D1 is square root of D2 is D1 minus square sigma root T. Now there is a lot, it appears as if this formula is very complicated. Actually, it is not. Let us understand each one of those. Spot is current spot. Okay. Strike price is K or X. Okay. Strike price is known. T is time. We know that. R is continuously compounded risk-free rate of interest. That also we know. Sigma. So in this particular methodology, Black-Scholes method, we use something called as sigma, which is the annualized volatility of stock price returns. Stock price returns, right? You use annualized volatility. So the sigma is annualized volatility. Then we use natural logarithm. Okay. And then we use the standard normal distribution function, that is area under the normal curve. So if you remember, we had this normal curve like this. So we are trying to find out the area of the normal curve covered by this particular number. So a normal, the value of that particular expression, right? Here you have an expression ND1. So ND1 is the area covered under the normal curve for this value of D1. Okay, spot into ND1 plus minus K into e power RT into ND2. What is D1 and D2 are given here, right? Then ND1 represents the hedge ratio. Right? This ND1 is basically the hedge ratio. Okay, and K into e power RT is your your exercise price, which is at present value. E power minus RT is present value, right? So that is present value. Now, it basically represents the borrowing, which is equivalent to the present value of the exercise price times an adjustment factor of ND2. Okay, you need not get into the depths of this formula. We even if the institute gives this particular question, they will not try and complicate, is my understanding, because as it is, there is a lot of arithmetic in this. So let us take an example. If the spot value is 185 and the strike price is 170, the risk-free rate of interest is 7%, time to expire is 3 years, the standard deviation per annum is 18%. Then find out the call value, right? So here I want to show you one more thing. If they don't give you natural logarithm values, you can manually compute using a calculator trick. Let us say you want to compute log of 30. In case of computation of e power something, we took square root 12 times. Here you have to take square root 15 times. Okay, then you have to subtract by 1 and then divided this by 0.00007021. So I'm just doing this for you. Log 30, right? So 30, you have to take square root 15 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So you will get 1.00010 something. Okay, then you subtract 1. Okay, then whatever is the resultant, you divide by 0.123470271. You have to remember this one particular number. If you do this, you will get the log value, which is 1.47716 or something like that. Right. So you have to do this. If they don't give you, ideally they will give it to you in the exam. But in case they don't give you, you have to use this formula. So Now coming to this our particular question, S0 into ND1 minus K into e power minus RT into ND2. So let us look at what are the numbers here. S0 is 185, K is 170. So S0 into ND1 minus K into e power minus RT into ND2. Right, this is the value of the call. What is D1 is equal to D1 is equal to natural log of S0 by K plus R plus sigma square by 2 into T. Natural log of S0 by K, S0 by K plus R plus sigma square by 2 whole thing into T. Correct? Right. So if you do this, we will get natural logarithm of S0. S0 is how much? S0 is how much here? 185. 185 by 170. 185 by 170. Right? I'm doing D1 plus R plus sigma square. What is R? 18%. Right. Sorry, R is not 18%. R is 7%. R is interest rate. 7% plus sigma. Sigma is 18% whole square by 2 whole thing into 3. Right. So which is natural log of 185 by 70. 185 divided by 70. 170. Sorry. 185 divided by 170 is natural log of 0.00588 something plus 7% plus 18% square by 2 into 3. So if you do this, what you will get is you will basically get these values 0.08456 plus 0.25860. I'm doing value for D1, right? Divide by sigma into square root of T. So you'll get this value. You will end up finally with a D1 value of 1.10068. Okay, I can actually do this, but it is better that you guys solve this. I'm going to give this as part of the solution. You can figure it out, right? Now, I want to show you something else. This 1.10068, this is D1. How do we compute the area under standard normal curve? That is ND1, 1.10068. What is this ND1? How did I get this ND1? So if you look at the normal table, right, I'm sure you're able to see what is the value? 1.10068, right? So 1 point, let me change the color. 1.100, 1.100 and 1.101. So it is between 0.86433 and 0.86650. 86433, 86650. This is 1.10 and this is 1.11. So you have to compute for 1.10068. You use interpolation and you arrive at a value for this. How do you do interpolation? So for a 0.01 change, it has changed from 0.86433 to 0.86650. That is, it has changed by 0.00217. We want it for 0.10068. How much is this? So you basically arrive at this particular number and then you add it, you will basically get a value which is closer to this. Now what is D2? D2 is D1 minus sigma of square root of T. So you basically again do sigma is this 18% into square root of time. Time is 3 years. So 18%, right? You do this, you'll get a value of 0.78891. And you take again normal value for ND2 is 0.78891. For that, you have to compute the area under normal curve. What is 0.78891? 0.78 and 0.79. It lies between these two. It is 0.78230 and 0.78524. 78230, 78524. Yes. So this value is lying in between these two. So you see, this entire thing is more about arithmetic or computation than actually doing something with, which involves any use of any analytical ability. So you have to be very, very careful when you use these. When you're making these computations, and then you will basically have to substitute all of those values into this and you will get the price of the call option as 51 rupees. The price of the call is high for one simple reason. Why? Current spot is 185. I have to buy it at 170 and I can buy it after 3 years. So this is in the money. In the money options are expensive. So intrinsic value is 15 rupees. Time value is 51 minus 15, that is 36 rupees. Okay. So this is how this is computed. You can manually compute and cross check your answers with this. And I've also solved this in the class, so I'm sure you'll be able to figure this out, because solving this on a live session is actually of no essence, right? You can manually compute it. Now coming to the last one, Greeks. This is the last part of the last slide of the entire thing. Just like what we have delta, which is change in price of option due to change in price of stock, we have other four Greek terms: gamma, theta, vega, and rho. Gamma basically is the rate of change of price of option due to change in delta. That is how much the option price changes due to change in delta. Theta is T for time, vega V for volatility, and rho R for interest rate. So that is how you can remember. Change in option price due to change in time. Change in option price due to change in volatility. V for V. R for R. So change in price of option due to change in interest rate. T for time. Gamma is change in price of the option due to change in price of due to change in delta. So if you beyond this, they have not actually asked more questions in the exam, given more stuff in the syllabus. So I don't think anything beyond this is required, but you need to understand what these are. If you understand this, I think it is more than sufficient for our exam purposes. So there I conclude my session, guys. I have, do not have anything else to add. If you have any questions, I'm more than happy to take. I have got very few questions, actually. Yeah, but anyone else has any questions? They want me to cover anything specifically? I'm more than happy to do that. Guys, nothing else? Okay, if we don't have anything else, I think I'll conclude the session here. Thanks a lot for participating in the session, and really appreciate your time on a Sunday evening. And we wish you all the very best for your upcoming exams. All the best. See you guys. Bye. Yeah, sure. The PDF will be uploaded as part of the description sometime. Okay.